Morning Call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios, coming out of a weekend and heading into a fresh new week. So much happening. So much was expected over the weekend. Some of it happened, but things are a little settled, which is good news as we begin this Monday morning. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, good morning.
Hi, good morning. Morning, Nigel. Morning. Well, I think it's escalating geopolitical tensions that are top of everyone's mind, right?
Yep.
What's happening with Iran and Israel and the kind of repercussions it would have on the market. For now, the sentiment will definitely get hit, but time will tell whether the dips get bought.
Well, we'll be analyzing the financial impact all through the day, but for the good of humanity, I just want all this, escalation to turn into de-escalation, and hopefully a better sense prevails and we have peace on this earth.
Well, it's a nice philosophical note to start the week. And
we'll do the numbers during the day, but, hard
No, absolutely. And why not, right? That, of course, is that's what everyone wants to see. Now, let's just quickly take a look at the escalation, right? So there was a flare-up in the Middle East. That's what markets were expecting, some sort of retaliation. It all started, remember, about a week and a half ago when Israel allegedly attacked Iran's embassy in Damascus, and a senior Iranian military official was killed. So markets since then was expecting Iran to actually launch a counteroffensive. And it happened over the weekend. So Iran launched hundreds of drones as well as cruise missiles at Israel. Israel, by its own admission, and its allies in the region, they intercepted most of these missiles, and Israel says the damage was very, very minimal. And comments then from Iran suggests that this is settled now. They basically said that we had to retaliate. Retaliation is done. And unless and until we get an attack now from Israel, we will not escalate this. So, and I think that is where things are at this point in time. There were also comments from Israel, but via the US officials saying that Israeli officials have told them that Israel is not looking at a larger response to what Iran has done. So it does look like, as we start another fresh week for financial markets, that things are, it's still on the edge a little bit, but maybe a little cooler as compared to where things were on Saturday or Sunday. Things are a little bit cooler and it's not as bad, at least right now. Now, as I said, markets were bracing for a sort of reaction, right? So US markets de-risked going into the weekend, bracing for an escalation. And what happened? VIX, for example, the CBOE VIX had a 6-month high. Actually, it went up all the way to about 19.5 and then cooled off a little bit from there. US bonds rallied about 5 to 7 basis points. Yields fell. You had equity markets which sold off. So the S&P was down about 1.5%. The NASDAQ was down about 1.6%. And oil prices, so these are sharp reactions which we saw. But this is all sort of going into the weekend in anticipation of the action that we can expect over the weekend. And oil, of course, stays north of $90 a barrel. I would still say markets are, what can kind of trigger a bit of an upheaval even from here is, of course, how Israel reacts. And that is, of course, something which we'll have to wait and watch. Hopefully, it will not be something large. And, this issue is kind of settled from both sides now, for the time being at least, and markets will move on. So that's where we are at with regards to this geopolitical issue. And you can look at sort of Asia's down, etc. But there's no big move on, oil or some of the other sort of indicators, typical indicators, or look at the Dow futures or the S&P futures, etc. There's nothing very large after what happened on Friday and over the weekend as well. Here in India, the Nifty closed below hourly averages on Friday, and we closed below the 40-hourly exponential moving average. Supports now stand at 22,270, which is the 20-day moving average, and 22,200, which is the 40-day exponential moving average. Now, even without all of these geopolitical tensions, etc., we were saying this last week that maybe for the next month and a half, in the near term, things could be a little sideways and we could actually drift a little lower. And I think this kind of ties in with what we are seeing globally as well. So the 20-day, which is around the roughly 22,300, just to round it off on the upper end, remains the pivotal point, which let's see if the Nifty gets to it. And if it gets to it, if it gets defended. Resistance, of course, is the 22,275 mark, which is actually coming in. Now, for the Nifty Bank, that has not broken the hourly averages. The Nifty Bank is still, by the way, above the 40-hourly average, which is 48,492. So that is the first level which the Nifty Bank needs to defend. If that goes, the support again for the Bank Nifty comes in at the 20-day moving average, which is 47,393. And on the upside, resistance stands at 49,057. So, just squaring off the levels and the numbers, the GIFT Nifty will come up on your screen. It's indicating a 130-odd point lower start. It's not large. I mean, it's not a big, massive fall out of which you really need to rush in and buy that dip. A little larger, and then risk-reward becomes a little more effective and a little more lucrative, which is not the case as we start with just about a 100-odd point cut today morning. Sonia.
Oh, absolutely. And something had to give, right? The market was rallying and rallying hard. So there was some excuse for a sell-off that the market was looking for. Yeah. If you notice in the last couple of days as well, the Nifty has actually come off about 200 points from its highs, from its record highs that we saw. So, of course, geopolitical tensions is something that's going to keep a lid on the market's gains in the very near term, especially today. The important question we're asking is whether the dips get bought and whether that's the prudent thing to do. Now, we have to see how this entire geopolitical issue unfolds. It could be a binary event. But the dips could get bought as well, because that has been the texture of this market for many days. Having said that, the next couple of days would be prudent to be a bit cautious as we head into some of these big events. Remember, a lot of the internals, global internals, are not looking good. Crude prices are at $90 a barrel. US 10-year yield continues to stay high at about 4.54%. The Dow had a big fall on Friday as well, almost 500 points gone. The S&P 500 saw its worst day since January because inflation woes are something that continue. In fact, the inflation data was higher than what Wall Street estimated, so maybe the rate cuts could be pushed out a little bit more. So all of that put together is something that has not been taken well by the street. There was large selling by FIs in our own market as well. FIs sold almost 8,000 crores in the cash markets on Friday. So yes, it's better to be cautious in the very near term. Having said that, some of the internals of our own market are not too bad. So if you look at TCS's numbers, for example, the margins are at a 3-year high. There were record deal wins in Q4, largely more positives than negatives in TCS's earnings, and that's something that the street would definitely like. A lot of results to watch this week. You have Infosys that comes out on 18th. You have Bajaj Auto on 18th as well. There's HDFC Bank on 20th. On 18th, you also have the Vodafone FPO that opens. So there's plenty of corporate action that we're going to be tracking. But for now, for the market, the start is going to be weak. It could be a bit protracted, the kind of, sell-off that we're seeing purely because of the geopolitical tensions and which way it goes. And the market was, I guess, looking for an excuse to correct as well, and they found that excuse. So a little bit of caution, perhaps, is the need of the hour.
Well, that's right. So if I look at Friday's trading session, though, and if you look at the intraday chart, I think the bulls out here were sensing that maybe there's going to be some bad news coming over the weekend, because we ended virtually at the low point of the day with a cut of around 230 points out, and the final tick was at the day's low. Now, two problems are faced ahead of us. One, on the global front, that is, domestically, everything's looking good. One is, what's the Fed going to do next? Because the data points coming out of the Fed, well, a little bit, muddled, so to call it. And that's why, in fact, that rate cuts now are being pushed down. So that's point number one. Geopolitical issues, it affects everything. Gold prices moving up, crude prices moving up, base metal prices moving up. So those are the key factors that are weighing on our markets. History suggests, though, that geopolitical tensions have been a good entry opportunity. Will it play like that? We've seen it numerous times in the past, and it's played out in favor of the bulls. So let's see how this one goes as well. In terms of levels that I'm looking at, well, the crucial support is around 22,200. If you're an aggressive trader and you have that kind of appetite, and if you want to buy, well, the 22,200 mark becomes extremely important. And I'll tell you why. Because the 22,200 put has the highest open interest on the put side. And also the 20 DMA comes in that vicinity of around 22,270 approximately. So both those two data points should come up for you on the screen. Well, what do the FIs do? Well, they unwound some long positions in Friday's trading session. They continue to remain net long, though, with 56% of their positions on the long side. And I was making this point on Friday morning. I like a market that's a little bit net short. I don't like an overtly net long market. And, the net long contracts have come down from around 50,000 contracts. It's come down to around 35,000 contracts short, but they continue to remain net long on the index. And just a few days ago, they were net short. So there's been a big swing factor out there. Still 33,000 contracts on the long side. The index that I'll be watching today is the metal index, because there have been some sanctions that have been put by UK as well as United States on Russia's metals. So that could provide a near-term fillip, because ultimately Russia's supply could make its way to other markets like China. China has been a big buyer of Russia's metal as well. But in the near term, we'll keep an eye out on the metal index because there could be a short-term pop given that there are restrictions that are put in place. So 130-point downtrend to kickstart trade. If you have the aggressive appetite, then the 22,200 becomes a line in sand for you, as I told you earlier.
All right, thanks a lot for that. Well, there's plenty of opinion coming through this morning, so let's get straight to it. On the equities front, first up, we have a comment coming in from Rhythm Desai of Morgan Stanley, who says that in temporal terms, this bull market is aging, but it's still young in terms of returns, especially because we see some distance for the earnings cycle to go, driven by some surprising changes underway in India. He says, therefore, this is set to be India's longest and best bull market ever, so stay invested.
All right, Amit Sachdeva, HSBC thinks that India is positioned for another good year. Consolidation, if any, he says, is likely to be shallow and create buying opportunities. He prefers auto, healthcare, energy, retailers, real estate, industrials and telecoms. Amit says risk-on plays include IT services, banks and chemicals as well.
Okay, let's also try and get you some money market views for the morning. B. Prasanna of ICICI Bank says that persistently stronger jobs and hotter inflation data in the US strengthened the dollar, which gained further momentum from safe haven buying of the dollar owing to heightened geopolitical risks. He says higher crude prices may trigger risk-off, affecting the EM flows negatively. He adds the rupee could be under pressure in the near term due to higher crude, geopolitical risks and a stronger dollar. However, he says the RBI will likely protect the rupee from a sharp depreciation and expects the rupee to trade in a range of 83.40 to 83.80 this week.
On bonds, B. Prasanna says that global bond yields are shot up post strong labor and inflation data with large rate cut expectations getting priced out, particularly in the US. He says risk-off sentiment emanating out of flaring up of tensions in West Asia, however, led to some retracement of this move. He says local yields have also moved higher but remain contained given strong investor demand and benign supply. He expects range-bound movement with a 10-year benchmark bond yield trading between 7.1 and 7.2%.
Well, we have a lot of stock-specific action to track for you. We'll get to that in just a bit in our special Top 10 segment. We're looking at TCS, Patanjali Foods, Senco Gold, Anand Rathi Wealth, Aster DM, Granules, ISMT, Varun Beverages, Ami Organics, and Metals will be on our radar as well. So most of them will be reacting to positive news flow. Let's see how it goes. Gift Nifty suggesting a downtake. So let's see how many stocks open up in the red.
All right, well, let's get some global perspective. Taimur Beg is Managing Director and Chief Economist at DPS Group. And Mark Matthews of Bank Julius Baer and Companies with us as well. Gentlemen, good morning. Great to have both of you here. Prashant this side. Thanks once again for being here on CNBC. Taimur, again, it's a lot into the mix, right? But generally, markets have been pretty buoyant, especially the US market and markets here in India as well. With what we are seeing, especially on two fronts. One is, of course, this entire inflation bit in the US and now this geopolitical tensions, etc. Do you think it can spoil the narrative or things look quite okay? Taimur.
Right. So this reminds me of days in 2018, 2019, when we used to say that it's not one punch. You need multiple punches for the market to sober down. And we ultimately needed basically the COVID pandemic to really bring the markets down. That, of course, it turned around vigorously when policy response came through. So I think we're in a similar situation, which is that we thought that high rates was going to spoil the markets at a time when you have very large yield gap. There's not much motivation to hold equities, but it looks like there's plenty of enthusiasm, optimism, and still lingering effects of a substantial liquidity injection. So it would take more than little skirmish in the Middle East where 99% of the missiles get shot down. So it's not really a major conflagration. It's a escalate to de-escalate type situation. And the clear risk element around Middle East is energy, and energy is so well supplied around the world right now with substantial excess capacity in the Middle East and the United States. So to me, this particular event is not sufficient to push the ever ebullient market to a downward spiral.
Oh, okay. That's good to hear. Well, Mark Matthews is also with us from Bank Julius Baer. Mark, would you concur that this kind of a skirmish may not be the reason for a major sell-off in global equities? Or are you a bit worried now? Now, worried I ask because there are so many internals which suggest a risk off, right? Whether it's gold prices moving higher, large buying from central banks in gold, the US 10-year yield shooting up, crude shooting up. Would you be concerned about equities now?
I would concur that this event in the Middle East is not going to take down the market. If you look at the previous 50-odd kind of shocks like this since World War II, it's clear the ones that do take the market down are the ones that have an economic impact, like the Yom Kippur War and the oil embargo in 1973. But then other ones, like when John Kennedy was assassinated in 1963, the S&P was 20% higher a year later because there was no economic impact. So the big question is, will there be an economic impact? And so far, oil is trading very well, as Timur said. I think in about 3 months, Iran will be attacked by Israel because it's very expensive to operate the Iron Dome. Probably cost Israel upward of $1.5 billion yesterday, or Saturday, excuse me, to shoot down all those drones and missiles. They can't keep doing that forever, and they do want to send a message. They think messaging is as important as action in the Middle East. And so when they do that, I don't think they'll hit any civilian targets, but I think they'll take the military targets, the infrastructure in Iran back about 30 years, which is what they did in Iraq and Syria previously. Then we'll have to see how the market reacts to that. That's a few months from now. But as it is now, I don't think this will have an impact. And you mentioned a whole bunch of other things as well, gold prices and interest rates. I'll just say that, and to Timur's point, the important thing is that actually the growth is good in the world and the United States. And if we do get earnings for the S&P of around 10% this year, then, and the consensus looks for a similar number in 2025, I struggle to see stocks going down.
Okay, all right. Thanks for that, Mark, and good to see you. Well, Timur, I had a question for you. Good to know that both of you gentlemen believe that what's going on currently in terms of geopolitics will not affect the equity markets at least. But Timur, I wanted to ask you about, we've got a lot of economic data that's come out, say in the last week or so. The jobs report came out, you had the inflation number, and then you had consumer sentiment that took a bit of a hit. Given all this economic data that's coming out of the United States, what are you expecting from the Fed for the remainder of this year? How many rate cuts and what quantum?
Right. I'm actually speaking to you from the United States. I'm actually in New York City right now. The mood as far as company earnings, the tailwind from the stimulus, the huge infrastructure spending, those things are substantial. On the margin, of course, there is some worry that the last few inflation data prints have been indicative of stickiness of inflation, that the journey toward 2% is difficult. And also from a consumer sentiment perspective, petrol pump prices going up a tad, rental prices firming up again, housing supply remaining tight. Those things don't help. But the fact of the matter is today's oil price is in real terms the same as it was 20 years ago. And I think we can all safely conclude that during the 20 years, the purchasing capacity of the Americans and the rest of the world has gone up substantially. So the ability to absorb higher energy prices, I think, is substantial. The ability to absorb high interest rate in the United States is substantial because there are very long duration debt products out there, including 30-year mortgages. People who took that 3 years ago don't have to worry about this interest rate cycle at all. So I think overall, the marginal concern with the economic data with respect to inflation or geopolitical tension, I think don't help. But the stock of strength, fundamentals based, is substantial.
A final question to you then, Mark, before we let you go. How would you summarize all of this? If there is a dip, right, just because of large risk aversion globally, is this a good time to be putting money to work in a market like India? Because we're headed into a huge election season as well. What are your thoughts?
Well, that depends how you quantify dip. Is that 1% or 20%? Right now, I would say for sure this is not a risk-on event. and the markets are treading water, and we'll need a few days to sort of figure out where we go from here. I wouldn't be a buyer unless there was a substantial debt, to answer your question.
You wouldn't be a buyer. Got that. Well, just have to wait and watch, I guess, which way things go, right? Taimur and Mark, thank you so much for joining us. Appreciate your time as always here on CNBC-TV18. Well, the market looks like it's going to have a dip this morning, but what are the stocks you need to look at? There are plenty of result reactions with TCS, etc. So we'll talk more about that later. We'll take a quick commercial break, come back with lots more.
When our big
Welcome back. Well, this morning doesn't look like it's going to be a good start, but we'll take it from where we start off in trade. Looks like it's going to be a 140-point dip. Reema's here to tell us how TCS's numbers looked and what the takeaway should be. Reema, over to you.
Thanks so much for that. So more positives than negatives. On the top line, there is a modest miss. The company's reported a revenue growth of 1.1%, lower than consensus expectation, but it's beaten street expectations on margins. EBIT margins are 26% and record high deal wins. That said, the headcount for the company has moderated for the third consecutive quarter, and the company has also gone on and said that FY25 growth will be better than FY24. JP Morgan has upgraded TCS to an overweight. They believe TCS will outpace, means do better than the rest of the pack in FY25, at least large cap. Goldman Sachs says there is an increasing probability of a double-digit earnings growth in FY25. UBS HSBC also bullish with a buy call. Nomura, though, has a reduced call on TCS. But remember, the stock was up 0.5% on Friday when the rest of the IT pack was under pressure. Back to you.
All right, Reema, thanks very much. And of course, in fact, we have the management join us in just a short bit from now to take the questions with regards to earnings. The CEO and the Chief Operating Officer will be the first you'll see here on the program. Now, Patanjali Foods and Senco Gold are also stocks with news flow. Mangalam is here with details on both. Mangalam, morning.
Good morning. So we start with Senco Gold. Jewelry is the one sector which has been shining for the last many quarters, and in that, Senco Gold has done well. In fact, it's grown the highest in the sector that has reported their update so far. The fourth quarter revenues of the company have grown 39%. Same store sales growth up 23%. Studded ratio higher than the same time last year as well, implying good margins. And the company said that higher gold prices actually impact the unorganized players more than the organized players. They've added 4 stores in the fourth quarter, and their FY24 volume growth have been high teens for diamond and low teens for gold as well. They're optimistic about the first quarter with Akshaya Tritiya and the wedding season coming by as well. For Patanjali Foods, the update has shown signs of improvement, and that's why I'm going with mild green on that one. The edible oil business has shown single-digit revenue growth and favorable EBITDA margins. Remember, oil prices have been coming down, so all these companies reported negative revenue growth. So in that, positive is something which is, the street would like. And the food and FMCG segment, which is the growth business, has seen high single-digit revenue growth, and the contribution to revenue has now crossed 30% versus 23%. So see mild green on Patanjali Foods.
Okay, all right. Thanks a lot for that, Mangalam. Well, let's hop across to Manisha. She's here to tell us about the restrictions that have been put on Russia supplies on the LME as well as on CME. Morning, Manisha.
Well, yes, metals have seen a surge early in Asia right now, and we are reacting to the US and UK prohibiting metal trading exchanges from Russian metals. Also, Russian aluminum and copper and nickel imports are barred into both of these countries. So you can't import it, and you can't even have it as delivered on the exchanges as well. We have seen that reaction come in for prices. So whether you look at copper or zinc, we're looking at 1.5 to 2% of a jump. Aluminum prices have gained up by 5% in Asia right now. The surge in aluminum is the most because we are looking at Japan buying aluminum on a longer straight. China aluminum imports have been on the higher side as well. If you look at the copper prices, we are looking at a 14-month highs right now. Zinc is trading at a 15-month highs as well. So clear reaction coming in for this. Markets in any ways have been on an uptrend because of the China strong data and Chinese demand. And with this latest, information and barring of metals from Russia coming in, you are looking at yet another leg of upsurge coming in here.
All right, thanks for that. Well, thanks, Manisha, for that. Well, TCS reported its fourth quarter earnings on Friday. Remember, the company reported a big beat in margins, clocked in record deal wins. However, they missed revenue expectations. So my colleagues Prashant and Reema caught up with TCS's CEO, K. Krithivasan, and the COO, N. Ganpati Subramanian. and began by asking him about the quarter gone by and how they see growth going ahead. Listen into that conversation.
We were able to improve our margin by close to 100 bips and deal wins were all-time high. So all in all, a very satisfying quarter.
What was your own internal expectation of growth?
We would have been happy around 1.5%.
1.5%. And where has the miss come in compared to your own expectations? You said certain geographies did well, better than expected, certain did not. So vertically and geographically, if you could tell us.
See, North America was very flattish. Maybe North America were expected slightly more. That could have, because North America being a big geography, even a few percentage points better than what we delivered North America could have tilted it.
Is 2024 looking better? I mean, is it looking like it's picking
For us,
up?
FY24 is over.
Okay. No, the calendar, I mean. F5 is over, but calendar is in front of you.
See, as we've been saying, we expect FY25 to be better than FY24.
Okay. How much better? I mean, are you getting confidence to kind of put some numbers in the ballpark?
That will be too early to call at this time. This year has been very different. Like, we've not been able to make a particular... see, people are making decisions at very short notices. So that would be a different call to make at this time.
And the US market, right, just because that's the big one, that's doing just fine. I mean, you get the numbers, the data points, the economic data points, jobs number, we got the inflation number. I mean, the problem there is that they want things to slow down. It's not slowing down, and but it's not translating into to orders and sort of spending decisions being quick and firm. Why is that, in your opinion, and do you think it'll pick up?
That's the anomaly. Really look at it, all the economic indicators are okay, and actually, if you look at the credit rate hikes, number one, or interest rate hikes, manufacturing is actually doing well. The consumer demand, specifically in the high-end fashion segments, they're all picking up. But then that's not translating into discretionary spends on the technology side, right? So, that's an anomaly that we see in terms of, why certain things are behaving certain manner.
The stock market is at all-time high.
Yeah, it's an all-time high. Yeah. So I think it's maybe it's explained to certain uncertainties like geopolitical situations, the wars, and as well as the election thing that's going on. I think it should ease out, but I'm not seeing anything fundamentally wrong with our customers. They're all.
The question is, if the big thing is higher interest rates in the US, right? 5.25%. If higher interest rates have not hurt, whenever interest rates come down, will they help?
That's precisely the point. Whatever models we all had, whether it's from economic perspective or from our own internal modeling of how that will translate into budget spend, etc. They're all, there's some anomaly, which means that there's something which is happening, which is influencing the decisions. I would attribute it to very, very fast pace of technology maturity and technology change, right? If you take Gen AI, every day there is something new happening there. If you take cyber security, the threats are getting bigger and bigger every day, and so people are investing in these areas, right? So I think, what everybody is looking at it is, okay, let's look at the war, let's look at what's going to happen in the Middle East, what's happening in the Ukraine side. Almost all major markets, if you look at it, there is an election, right? So let's see how these things pan out, and should we really invest in Asia, should we really invest in North America itself, right? So many variations that are going through our customers' minds, which actually the only reason that I can put in terms of explaining why they are holding back some of this. At the same time, the AI as a centerpiece, the architectures are changing, right? And they want to make sure that the architecture that they choose and a multi-cloud strategy that they choose and the resilience that they want to bring into the overall technology, all that, they want to probably assess and make sure they get it right, before they step up the gas.
That is delaying things.
I think so. I think, basically there is a first phase of any new technology transformation, if you look at it, getting the architecture right. And have we got the multi-cloud strategies right? Is there a scope for a private cloud in the overall multi-cloud strategy? How do we use the LLMs? and what part of my data that I don't mind sharing it outside, what point of data and what part of the competitive advantage that I want to keep it inside. See, there are multiple things at play. So all that probably is taking that decision a little.
But that's very well explained, NGS, to understand why spending is taking time. But Kriti, discretionary spending, has it further deteriorated? Because Accenture spoke about it.
See, if you look at again from our deal wins, okay, we reported a huge, significant deal win. And if you cut that, right, about 55% of that is new or discretionary spend, and about 60% could be non-discretionary. Again, non-discretionary could be in terms of some of them or maybe renewals, some of them or regulatory changes, if you can put it. So I won't say it's a drastic reduction. Like, people are wanting to spend, but at the same time, like NGS mentioned, like they also want to conserve. Like, if things turn around to be good, if they all become confident the economy is going to grow faster, they need to be ready to sprint and ready for the transformation. So there is a certain amount of getting fit also being done. So I won't call it the discretionary spend is decisions are being made. I don't think there is a huge slowness, right? But what is happening is the old projects, we keep talking about it. There is a slowdown or pause of the old projects where they don't see the ROI. That's a continuing trend.
Okay. And margins, are margins sustainable at 26% according to you, X of the decline that we'll see in Q1 because of wage hikes? But other than that?
We believe structurally it's a sustainable margin. Like, we worked hard to get here, and we'll work hard to stay here.
On just a personal point on AI, because that's a big thing which is happening, right? And everything is in a flux, as I think, if I paraphrase what NGS told us. Is it a net? How far out from when we are able to kind of sort of start talking about projects on that side? When does it become a net positive? When does it stop delaying projects, and how far out are we, you think?
See, like, there are a lot of experiments going on, a lot of exploratory work going on. Like, as of today, I believe we are doing close to about 200 plus engagements, and our pipeline on this one is close to 900 million AI plus Gen AI together. So there is a lot of activity going on. And as like with any other hype cycle, there will be some realization on what is the art of possible here, what you should do with Gen AI, what you should not try to do with Gen AI, because it's fairly a compute intense technology. It's not going to come cheap. People also try to understand how expensive it is or where are the economic benefits. It will probably take few more quarters, right, for them to understand which are the appropriate use cases for this technology.
Just to get the number right, $900 million is the pipeline
yeah,
for AI and generative AI.
Correct, yeah.
Okay. NGS, particularly on communications, right? This quarter, communications on a quarter-on-quarter basis appears to have fallen slightly. But one would have thought the ramp-up of the BSNL deal would have contributed positively. So are there any other clients in communication where there is pressure, or what explains the performance?
For BSNL, that is not reported under communication. BSNL gets reported on the regional markets.
Okay. But in the verticals, it's...
Our vertical is, you have CMI, and the regional markets includes India. It gets included in
which
India.
is up 26% on a year-on-year basis. Okay. And what about BFSI? BFSI is still flat. The last time we spoke, I think there was hope that there are green shoots in BFSI and will start improving.
I think, overall the deal momentum is there. We have done close to about 4.5 billion out of the overall 13 plus billion is from BFSI, right? But as I said, BFSI is one of the segments which is very quick to adopt technology, which is the one which tries out everything new. In that context, I think the artificial intelligence, multi-cloud, and things like sustainable financing, Basel III kind of experimentation that they have to do. Many such areas is something that we are participating. But then all this the momentum will pick up as they finalize the first phase of saying that this is how I want to do things. This is the way that it has to be let's say, disaggregated, or this is the way that it has to be aggregated for dashboards and MIS purposes and all of that. So I think there's nothing wrong which we see in our customer base. We are engaging with them very positively, but there is a certain amount of caution in terms of, look, where is it the geopolitical risks are going, and where the technology side of it, how am I going to actually get it right? Because every time they do, when they accelerate it, if something new happens, then the question comes back saying that, have you made the right decision on the architecture, right? Okay. So I think that's the way that I think there are some delays, but overall, I don't see anything wrong with the banking financial services sector, especially in our client portfolio.
Would you say AI is the biggest, would both of you agree, is the biggest sort of X factor in that sense, which will determine how fast things come back?
I would say yes, from both positive perspective and a certain amount of pessimism which is there. See, if you really look at it, there are regulations that are being talked about on AI, right? So everyone is now looking at AI for internal use, right? But at the same time, if I'm going to make use of the artificial intelligence for customer-facing situations, there are two things that we have to answer. One is that we have to make it responsible. Second is that if regulation comes and does something, and then how am I going to roll it back? Or so that from that perspective, all the efficiency-related use cases internally that is happening is what is the focus. While they are
within TCS, but customer-facing.
No, not only within TCS,
right.
Within the customer,
okay.
Let's say back office efficiencies or technology efficiencies that they can do, they're all fine, right? But if I'm going to make that analytics to put to use for, let's say, interacting with customers better, or making the customer interactions much more efficient, etc., there is some tentativeness, because the models which they're planning to use, will they be regulated? Or if they regulate it, then what will be the impact? Am I going too much far ahead, and then it will be difficult for me to pull it back later? So there is certain amount of caution in all of that.
Okay, well, AI is the big X factor which will determine how fast clients start spending money. Older projects, clients are delaying as they don't see requisite ROIs. But overall, remain positive that FY25 perhaps will be better. Quick commercial break here. We come back and we play out some of the important sound bites from the TCS's CFO and the CHRO. The conversation follows in just a bit from now. Stay with us.
Welcome back. Well, we are getting into a brand new day of trade, but a couple of stocks that you need to watch on your radar. One of them is Indian Hotels. UBS actually has a buy on the stock. They've raised their target price on Indian Hotels to 715, and they say that there are a lot of internals which are leading to an earnings upgrade for Indian Hotels. So 715 is their target price there. Keep an eye. Talking about target price upgrades, Exide is also another one. Morgan Stanley has raised their target price to 485 from 373 earlier. So, big up move over there. It could be expected. And Zomato, UBS has raised their target price to 250 on the stock. So, keep an eye out on these three names. But let's get back to TCS now. We caught up with TCS's CFO, Samir Seksaria, and the CHRO, Milind Lakkad, to discuss why the headcount has moderated for the third quarter in a row, and is the margin growth sustainable? Listen in.
We are very pleased with it. We are touching a guiding beacon, and that's something which we have always believed in. If we look at, so that's a 100 basis point sequential improvement, and if you look at it, that's in spite of a 90 basis points headwind coming in from higher third-party expenses and increased travel expenses, which was offset by 190 basis points coming in from bottoming out of subcontractor costs and productivity and utilization gains.
So subcontractor costs have bottomed out?
We believe so. It's at 4.6%. That's 150 basis points lower than the previous quarter. I think now It would still depend on the macro, how it plays out, but we believe it is bottomed out and we should...
And what's the outlook on margins going ahead? Does it stay at 26% other than the wage hike quarter? Say next time, exit margins for FY25. Can it be better?
So let's be happy with what we have been able to deliver in FY24, and exiting Q4 at 26 is really special. Yeah. We are happy with it. If you look at the past 3 quarters, we have almost delivered 100 basis points sequentially, plus minus, but 100 basis points coming in each of the quarters. So and we'll continue our focus on disciplined execution.
You know, Kriti and NGS was telling us earlier that FY25 is going to be, and NGS said much better than FY24. So there is a bit of a operating leverage or whatever you want to call it, right? So margins perhaps could be better if growth picks up.
So definitely growth is a big lever on margins, and if growth picks up and is better, it will definitely accelerate the margin journey.
And do you think growth is looking, as you from your vantage point, is looking stronger?
I'm sure,
the year ahead is looking stronger?
I'm sure Kriti and NGS would have given you better color, but we believe FY25 will be better than FY24.
Milind, headcount is down for the 3rd consecutive quarter. You know, so do you think it's going to continue to moderate from here on?
Yeah, no, I think Samir talked about productivity and utilization. All of that stuff is all coming together, and plus our investment made in the past. All of that together coming together is what this result is going to be, right? You know, this is last quarter you asked me and I said, yeah, I will not be surprised if it is negative, and it is turned out to be a lesser negative number. So we expect to drive the same kind of efficiency going forward. Growth will come, we'll hire more, and then we'll have...
So to drive this efficiency, is it possible the next quarter again headcount declines?
No,
will you be surprised?
No. Then let me put it this way. I think it's a function of our efficiency, what we hire, how many we hire, and eventually what the business growth is going to be. All of this together, whatever that outcome will be, will be.
You know, Milind, the linear relationship between growth and number of people that you need, right? That has not been true for a while now, right? I mean, there's non-linearity. You can do more with lesser number of people.
If you bring in the time dimension into this, you can still relate to it. But our intent all along and our drive all along is to basically have a soft linkage to these two things.
Right.
Headcount growth versus revenue growth.
Right. No, my point was now with AI, etc. as well. Can you give us a broad sense? How many people that you potentially would have hired, you did not because of these new technologies? I mean, if you can give us some sense of that.
Prashant, it is too early to say that. No, currently we are in a POC mode. We are doing hundreds for POCs, actually 300 plus POCs we are doing right now across customers.
Sorry, POCs?
Proof of concepts. Proof of concepts. No, with our customers. All of that, and eventually coupled with all the other enterprise-related challenges, all of this will take some time to basically come to that point. So we will play and we'll obviously keep you posted as we go along.
But you don't think it's already happening?
It is not to the point of enterprise level changes at this point in time. We actually, customers are still testing out. Customers are still figuring it out basically how it is going to be all work out. How eventually the accountability of the software generated by AI, how it is going to be managed.
Because now you're saying that, I mean, if you talk to educators, it says they don't need to learn, kids don't need to learn coding anymore. You can tell the computer to write the code, ask it to do it, and it'll do it. So at a very basic level, simple, I mean, of course, you'll always need programmers and, certain set. But the vast majority, you think, there's going to be a challenge?
You will still, basically, the role of the developer will change. The role of developer will change. There will be an, AI co-pilot which will work with you to get the job done. How will you get the job done from an AI co-pilot? What will you do? What is your role change that is going to happen is currently being reimagined in TCS and in the industry.
Samir, do you think peers may have dropped the margin threshold to chase growth? Is this something that you've seen in the industry? Not you, but the industry, your peers.
I can't talk about peers, but I think we have always believed in growth with profitability. We'll never let out an opportunity for growth at the cost of profit. I mean, just because of profitability or margin thresholds, nor will we chase growth just for the top line, which does not do a value add for the customer for us as an overall enterprise.
And Milind, on demand right now, so far you're able to manage the current demand with a lower headcount, which is what's driving your utilization, productivity, etc. When do you think the company will start hiring to meet demand, which you can't meet with your existing
We already are
employees?
hiring. We hired a whole bunch of
But
numbers.
the net headcount is falling, right?
But the point is, we are hiring the point is big numbers are hiring. There are people who are leaving. The point is just net headcount is dropping. Eventually, when the like he says, as the business start showing more positive signs, then we are anyway going to ramp up like we always do.
Is this going to be just-in-time hiring, or you think there's already slack in the system?
We do. There is already slack in this. There is always some slack in the system, right? We always keep that slack.
So it's not necessary if growth picks up in 25, it would be a net positive number on the hiring front.
No, it can be, and there's a very high chance of that it will be.
It will be.
Okay. I mean, at what point of growth do you need to start hiring? I mean, if I can put it that way.
So you mean to say we are anyway hiring Prashant?
At a net level. Sorry. When will that net number tick positive?
Yeah, I expect it can happen as early as next quarter.
Okay. Because the assumption is that if growth is going to pick up 2 quarters down the line, you need to hire today and train them so that when demand picks up 2 quarters down the line, they're ready.
So let me just put it this way. From campus, we are the first ones to go to campus. We already basically gone to our priority institutions and made, tens of thousands of offers.
Okay.
We already started NQT, our phase has started. So all of that is proactive. Now, from the market, from experienced talent, which we get every quarter based on the required demand.
What's the fresher addition that you're planning for FY25?
So, it is hard to give the number right now.
But you always give us a number, right?
I give a number of 40,000 every year. 40,000 every year. I don't expect that number to change significantly this year, but I cannot tell you exactly what that number will be.
But you had a strong start this year, right? At campuses, etc. as you said.
Yeah, absolutely. That anyway is part of core part of our strategy. We will go to campus every year, no matter what.
What kind of deals do you see where there is room to ask for better? I know it's a overall tough environment, but are there any segments which are doing well and where you still have pricing advantage in that sense?
So we'll have to look at pricing at a portfolio level.
Yes.
And pricing. So if margins have to improve from here, we believe pricing will be one of the biggest levers, or need not be one of the biggest levers, but one of the major levers playing in. But pricing doesn't mean it will change overnight. So you can't go to a customer and say, I'm hiking the prices next day. But it will be more structural. It would be more evolved over the period. It would happen through portfolio level changes, subtle changes. When contracts come up for renewal, pricing will see an increase. The new deals which will come up will have an overall higher price baked into the deal itself. That's how we'll see the pricing change. If you look at our realization, and I'm talking of realization, which has productivity benefits also baked in, but realizations have been steadily inching up over the last 5 quarters.
Do you want to put a number to it? How much have...
If you look at the revenue per FT, it has increased substantially.
It's increased substantially. Okay. So you believe FY25 is going to be better than FY24, right? By how much? And when... Right now, it appears that earnings growth is steady. The revenue growth is steady. There is no pickup. Revenue growth in March is similar to the revenue growth in December. When does it start picking up in your own assessment?
Well, rather than putting a specific timeline, if you look at it from a medium to long-term perspective, given the deal wins which we have been having, and the overall demand drivers which are in place, we are fairly positive about it. Near term, as we see, is fairly cautious and cautionary.
Well, time to slip into a short break. On the other side, we'll get you how do you trade the index today. Mitesh as well as Sudarshan will be joining in to tell us their index trade as well as individual stocks. Stay with us. Welcome back. You're tuned in to Bazaar Morning Call. Well, as promised, let's get you a technical check on how do you trade the index today. Our technical experts, Mitesh as well as Sudarshan, join in on the show. Good morning, gentlemen, and thanks so much for joining in. Well, Mitesh, you go first. We ended at the low point of the day on Friday. Things didn't look very, very good. And today we're going to see a gap down of close to around 130 points going by the GIFT Nifty. What do you do from there? Do you look to buy into the index, or do you say, no, there's plenty of uncertainty, you rather stay away and in fact maybe buy at lower levels?
Morning, Najib. So I think, on Friday, we had suggested that if we start trading and closing below 22, 530, 550 zones, it will be time to exit longs. We did that, I think, because one, we were closing below that level. Secondly, I think that was also the day's low. So the indices were closing near the day's low, hinting at possible continuation of this pullback or decline. Now, I'm looking at the lower levels, 22,400 and then 22,250 are the two support areas in the near term. So I think, maybe if we open on 22,400 and then we don't see any follow through, then maybe attempt a long trade. But for me, I think the structure is slightly weak. So there is a higher chance of us heading towards 22,250 levels. So I think around those levels we'll explore buying, not immediately today.
Okay, well, Sudarshan Sukhani is also with us. Sudarshan, do you think the markets will correct in a big way? I'm asking because there are geopolitical tensions now. There's also escalation of crude prices, the US 10-year yield, etc. How are you approaching it now?
Well, good morning. The markets have entered into some kind of a correction on Friday. And as we see that there is going to be a continuation. Now, it's difficult to say at what point this correction will end. That only the market will give us a message when that event occurs. But we are in some kind of a correction, and in a correction, it becomes very difficult. You can't go short. You have these downside gap up, gap downs. It's difficult to go short there. In any case, corrections are meant to be, places when you step aside and say, okay, let this dip come about, and then I'll be a buyer once the base building process starts. So for me, this is a correction of some kind. It's a complete avoid for the Nifty. I would only be a buyer once the markets stabilize. I'm not looking for short selling anyway. The Bank Nifty is a different story. It is possible for the Bank Nifty traders to look for sharp intraday dips to buy. That is only a buying opportunity intraday and on sharp dips.
Okay, got it. Got your view, Sudarshan, on the index then. But let's talk about stocks then. Individual stocks must be having some ideas, right? Please fill us in with them.
Yeah. See, it's a buying list. And the reason is that after a gap down, good quality stocks will probably at least hold on their own. Laurus Labs is a buy with a stop under 432. Bajaj Auto is a buy with a stop under 8,773. Shriram Finance is a buy with a stop under 2,417. And Voltas is a buy with a stop under 1265. The stops will have to be adjusted depending on the gap down. But the idea is that good quality stocks should be bought on dips, and this is a dip.
Okay, and Mitesh, what about you? What would be on your buy and sell list today?
So I have more of sell calls, purely believing that 22,250 will be a more logical target, and therefore I think we will see, even if there's some kind of pullback post the gap down, there's a higher chance of supply coming back again. The solitary buy call which I have is Bajaj Finserv, which I would want to buy closer to about 1685-90 zones. Keep a stop below 1669. Look for 1720 as the trading target. But that apart, on the sell side is Hero Motors with a stop above 4500. Look for targets of 4320 on the downside. REC is a sell with a stop at 446.5 for targets of 422. And Alchem Labs is the third and final sell call. Keep a stop above 4780. Look for targets around or below 4600.
All right, gentlemen, we'll take a quick commercial break here. We'll come back and we'll get the pre-open going with the first rates, which will start to tick in. There's 5 minutes to go for that. Prakash Diwan will be here with some analysis of fundamental events, specific stock bets, etc. that we want you to take. Stay with us.
In the jungle.
Welcome back. Prakash Diwan is joining us now to tell us how to approach the markets and, of course, all the stocks that are in the news. Prakash, hi, good morning. First up, have to ask you about TCS, right? The management commentary was decent, record deal wins, margins are looking good. At this price, is the risk-reward favorable for investors?
Good morning, Sonia. So I think what they're trying to convey from most of the commentary is that while things were good in quarter four, they were not as good as they would have liked it, which means there's always room for improvement, which is meaningful. And to Prashant's question on how good would FY25 be or calendar 24 be, while they were cagey, that very clearly indicates that it's part of an industry trend where they'll probably be the forerunners for any improvement that happens, whether it comes from the AI side, whether it happens from a BFSI turnaround, the quick adaptation to things. So I think the commentary was far more indicative of things to come, favorable things to come than the numbers alone. And from that perspective, yes, it could have some legs. We've seen it rally much beyond the other 3-4 larger players in India. But I think it's now looking for a setup where the global industry trend, with the goodness of the global industry trend on its way up, would probably be captured by TCS very, very well. So I would believe at least a 15-20% upside. I've seen some targets come through in the same vicinity, and that seems very logical. So it becomes a great buy on dips if something goes wrong from a overall market softness perspective. You probably know that this is a stock, a large bellwether stock that could give you 15-20% on the next 12 months.
Okay, all right. Hi, Prakash. Good morning and good to see you. When you have that news with regard to Russian supplies, they won't be traded on the LME as well as on CME. And normally in the near term, that gives a bit of a pop. But, we know what happens in the longer term, because if I look at it from the highs of the day, aluminium prices have as just come off $60-70 from today's high. Your view on the stocks, they're likely to open up. That's Nalco, Vedanta, as well as Hindalco. But what from there?
Good morning, Nigel. So, from a slightly longer term structural perspective, I still like Hindalco. We spoke about this post the disappointment in the last earnings call, where they spoke about a huge capex in the US business. But that is something which will consolidate their position globally. And if you're willing to wait for some of these uncertainty to play out, by the time the next 3-4 quarters roll out, it's going to be very, very strong. So that's clearly a good medium to long term bet. But in the short term, if you look at Vedanta, I mean, barring certain issues that we've had disappointments with some of the management decisions on capital allocation, it sits in a very sweet spot, Nigeria. And it's firing on all cylinders, whether it's oil, whether it's copper, whether it's aluminium, whether it's zinc, silver. I mean, you name it and they have it in their bag. So all of that is probably what could capture the salience in the short term. And this short-term bump up that you spoke about, this pop is actually going to help Vedanta more than any of the other players because of its global presence in that sense. And investors also know that it has things which work, and that that planned demerger of sorts will only kind of create some sort of a opportunistic play in the stock. So I think from where it is, it's moved very smartly, right? From the 240, 250 zones to all the way here. So it could probably be the joker in the pack at this point in time. But I would look at Hindalco from a slightly more longer term perspective.
All right. Stay with us, Prakash. I just want to sort of touch upon the other big thing which happened over the weekend, which is, of course, the BJP releasing its manifesto for elections 2024. Parishad is now joining in with the key highlights from what he's picked up on the economic side, the policy thrust which the BJP is saying they will bring about if elected back to power. Parishad, morning.
One important point that the Prime Minister spoke about is that the government will continue following the path of fiscal prudence for economic growth. So that's why we have mostly in the manifesto seen continuation of existing schemes, a lot of focus on infrastructure for employment growth, and continued support to farmers, to the poor of the country with free rations, and the PM Kisan schemes as well. Now, the important point here to mention is that they reiterated that the BJP is committed to making India the third largest economy, and they want to make it the product nation or the manufacturing hub of the world. There will be a lot of investment in employment. There will be an expansion of the Mudra Yojana for entrepreneurs with an increased limit of 20 lakhs for entrepreneurs who repaid previous loans. The Ayushman Bharat Yojana, that will be extended to senior citizens above the age of 70 years. Free rations will continue for the next 5 years. The free electricity scheme for poor households will be there under the PM Surya Ghar Muft Bijli Yojana. There will be a lot of push towards self-reliance in pulses and edible oil. More rural women will be empowered. For example, the Lakpati Didi program, they hope to empower at least 3 crore more women in that. A lot of focus on domestic defense manufacturing. In fact, the Prime Minister said that we want to expand domestic defense manufacturing in air, land, and naval systems and increase export of indigenous equipment. The pharma sector will be a big focus for the government. The Prime Minister said that they want to boost manufacturing and research in APIs and expand PLI in the pharma sector. There is also a vision to make India an electronics hub by 2030, energy independence by 2047, reducing imports of petroleum. Electric vehicles also found big mention in the Prime Minister's speech. In fact, the manifesto said that the government will be investing heavily in a nationwide EV charging ecosystem. A master plan for airport transformation is on the cards. New airports, aerodromes, helipads, and the government will ensure a national review of floor wages from time to time. There was a announcement which has been there in previous manifesto, which is reiterating the government's commitment to the Uniform Civil Code, implementation of CAA. So these are things which we will definitely see over the next few weeks. But largely the focus was on fiscal prudence for economic growth. And the Prime Minister said that India will be a bright spot despite all the geopolitical challenges, and we will continue on a path of low inflation as well.
Got it. All right, Parikshit, very helpful there. Thank you so much for joining in. That's BJP's election manifesto. But let's get back to the market now. Prakash Diwan is still sitting by, and the pre-opening rates are kicking in. So let's react to some of them. Prakash, I wanted your thoughts on Indian hotels because there is a brokerage report from UBS where they've actually raised their target price to 715 there, and they expect more earnings upgrades on Indian hotels. And we've all seen how this whole travel tourism space is picking up in a big way. Would you still recommend buying it at this price?
Oh, absolutely. I mean, this is a space where I think there's significant amount of capital allocation that's already underway, and it's just likely to go manifold. The reason is very simple. It creates employment like no other sector does. The second is that the right to win for some of these brands, which straddle right from luxury to affordable to, so you have the Taj extreme high-end luxury segments to the Ginger, which India Hotels straddle so very effectively. And what's happened is after some of their recent capital raising issues, events, it's got a balance sheet that can not just expand very fast, but it can expand very profitably. So that was missing, a few years back. And as a matter of change, what's happened is the commentary that actually talks about getting into the right pockets, right segments, but very aggressively. ITC has been talking about doing it. EIH has been doing it quietly. You have some of the smaller players like Lemon Tree and all. But Taj has a very different, Indian Hotels has a very different model where, the ROAs are far more effective as compared to some of the other names. So I believe there is a case for a merit for re-rating there. Now, how soon that happens will be correlated to the expenditure that the government starts making in some of the new areas. But absolutely very positive on this space, and there's no reason why you should be out of it. We spoke about Thomas Cook and some of the other names also in that same vein, but Indian Hotels does become the proxy to any kind of a capital enrichment of sorts in this space.
All right, just stay on. We'll come back to you. Well, let's focus on the IT sector once again. Apurva Prasad, research analyst, IT sector at HDFC Securities, is joining us now. Apurva, thanks so much for joining in. Your view on the numbers that TCS reported, but more importantly, the commentary from the management that we just heard a while back. And what is your recommendation on the stock now?
Good morning. So we remain positive. It's been our top pick in IT. I think there are some of the factors around Europe, which we had put out earlier, those are favorable. Some of the onshore hiring factors start to become favorable for the company. So essentially, our numbers are not changed too much. I think margin positive ahead of estimates. I think that's the key standout. On the deal side also, what that does is that gives a greater visibility on the acceleration for FY25.
Okay, all right. Yeah. Okay, so you continue to remain positive, based on that margin beat. Hi, Apurva. Good morning and good to see you in. What's the read-through for the industry, though?
So, in terms of execution, and if you look at some of the factors driving that outperformance, I suspect some of the companies could show a similar trend because it's essentially getting subcontracting lower, and subcontracting levels have gone back below pre-2013-14 periods. So I think some of those factors could also play out for other companies, and that's something that we've said that I think from operational environment, I think a lot of factors remain favorable. The fact that attrition is at below pre-COVID levels, and some of the operational levers continue to be tracked. I think those would enable, which is why we do expect margin expansion for a lot of companies in FY25.
You have Infy's numbers as well this week. What are your expectations?
Yeah, so Infosys, we expect them a flat sequential performance on the revenue side. We were expecting TCS to outpace within the tier building in much higher levels of bookings. Infosys should certainly be more flat on a sequential basis. We're expecting them to probably guide to 5% or so. So I think anything above 5%.
Right. Purva, in mid-caps, your top idea?
Prashant, so persistent is something that we've liked consistently. I think drivers, growth premium versus peer set, margin expansion play, sustainable play, also something to play on the Gen AI side. So pick most boxes.
So you said that you're positive on TCS, but on Infosys, I didn't get the call. What's the medium-term call on Infosys? What's the target price now?
Yeah, we do have an ad rating on Infosys too. We do have an ad rating, but between the two, we see a bigger upside in TCS. We think the outperformance in TCS will continue. So within the tier 1 IT pack, we have an ad on TCS, Infosys, and LTI Mindtree, and reduce on Wipro.
On the valuation front, do you think there is a lot more upside for a name like TCS, considering that it's sitting at premium valuations already? Do you think that would limit its upside?
Not really, Sonia. I mean, if you sort of compare to the 5-year average, it's pretty much there. I mean, 5 years, 27 times. They are about 28 times FY25, 25 times FY26. Even if you see on a PEG basis, the average has been more like 2.4, which is where our target multiples are. I suspect there is still probably some room for multiples to go up in a scenario that there is an earnings upgrade. And if you look at the sort of historical last few quarters, the earnings estimates have been most resilient there. And that should also be another factor as things start to rise.
Purva, just sort of one last point. For the kind of growth that at least large cap IT will show, and we've already had numbers from sort of TCS, right? Investors have a choice. Within, of course, I mean, if you're an IT investor, then this company or that company. But growth here as compared to, I mean, other sectors, just this is a slightly broader question. You think it's exciting enough for the sector to do well, even in FY25?
Yes, look, I think a big part of performance, stock performance probably driven post the Fed pivot, post November. So if you sort of zoom out and what's led to the bigger sort of uptick there. But look, even if you look at fundamentally, we're saying that it's certainly bottomed out. One can make a case that margins have bottomed, growth has certainly bottomed now. Where that gradient of that uptick is, that's something that remains to be seen. But we do expect an acceleration. The good thing is that the deals that they already have in bag and those have been ramping up, that gives a reasonable amount of certainty into acceleration for 25. So 25 versus 24. So in case of TCS, for example, 3.5% is accelerating to 6.5 or so. We're looking at 200-300 basis point acceleration broadly. I think that's a good situation.
Okay. Also, TCS, the CEO said that AI will be the X factor on determining how fast clients are spending, right? So perhaps a lot of these companies that have an exposure to generative AI will be in focus. But thanks a lot, Apurva, for joining in. Thanks for giving us your thoughts. Well, it's 9:10, so let's get some calls in. Sudarshan Sukhani is back with us. Sudarshan, what's the big call at 9:10?
Well, consider buying Bajaj Auto. The initial stop is 8,773, but adjust it according to the gap down.
All right. Mitesh, what about you?
I'll go with a short on Hero Motors and look for targets of roughly around 43.20.
Okay, all right. Thanks a lot for that, gentlemen. Well, let's hop across to Vamakshi. She's here to tell us about some cable companies. Vamakshi.
Well, absolutely. Motilal Oswal has gone ahead and initiated coverage on a few counters like Polycab, KEI and RR Kabel with a buy rating. For Polycab, they've given a target price of 7,500, for KEI at 5,000 and RR Kabel at 2,200 per share. Largely, they have highlighted that Indian electrical industry, which is at 1.8 lakh crore in FY23, is likely to post a nearly 10% CAGR. The cable and wire industry particularly is expected to benefit because it constitutes nearly 40% of the overall electrical industry. The industry will be benefiting from rising of exports of cables, and in fact exports clocked a CAGR of almost 16% from FY17 to FY23. The demand for organized products is, especially branded products, is also rising, and therefore they expect all of these companies to benefit because they constitute nearly 50% market share amongst the organized players. The companies are favorably placed, and they could gain from rising infrastructure spending as well, and they believe that the premium valuations that these companies command could actually sustain. So given all of those factors, Motilal Oswal has gone ahead and initiated coverage on all of these counters with a buy rating.
Thanks a lot for that, Vamakshi. Well, let's focus on the metals pack. The United States and United Kingdom, they have taken action to reduce the Russian revenue from metals. So LME and the CME, well, they will no longer trade new aluminium, copper as well as nickel that's produced by Russia. Why is this move taken? Well, the move is aimed at curtailing Russia's income, which would make it difficult for Russia to fund the war against Ukraine. What's the impact? Well, it will result in a near-term pop on metal prices. Longer term, though, we normally see these prices come back down to parity. So let's see how that works this time. Stocks that should be on your radar: Nalco, Vedanta, Hindalco, as well as Hindustan Copper. Can Russia find a way out? Well, since 2022, there has been a notable increase in Russian metal sales to China, as some of these Western buyers have sought alternative supply. So let's see how this goes. Near-term pop, but sustainability will be key.
All right. Well, right on cue, Nigel. The market open, first ticks coming up. I think the pre-open was indicating a open around the 20-day, not exactly, but 22,270 is that number. We start with the open is coming up on your screen, 22,359. So about 70-80 points above the 20 days where we are opening at, 0.75% lower. So it's a 150 odd point cut. So nothing large, right? This is par for the course, as earlier GIFT Nifty was also indicative of. So give it time. I mean, the first 1-2 hours, and see if the market is able to sort of sustain, defend, and then maybe you kind of look for a pop higher once again, a buy and dips kind of thing. Nifty Bank is down about 0.75%. We're down about 400 points. So that's a bit of a cut. 1.5% cut on the mid-cap index, and I think small caps are also opening lower. So red as far as the start is concerned. But let's talk about stocks. Sonia has got those. Sonia.
Well, thanks a lot for that, Prashant. So as you rightly pointed out, it is a weak start, and this was what the street was expecting, right? Given the kind of geopolitical tensions that we're dealing with Israel and Iran. But let's move on to individual stocks now. TCS, the result reaction, we're expecting it to be in the green. It's not as bad. Actually, it's outperforming the market because the margins were at a 3-year high. It was record Q4 deal wins. The management commentary was positive as well. So TCS is down but not out. JP Morgan, in fact, has upgraded TCS to an overweight and raised its target price to 4,500 from 4,000 earlier. Indian Hotels is the next one. We just saw it on the screen. UBS has a buy. They've raised their target price to 715, and they say that earnings upgrades are expected on Indian Hotels. So that stock as well, while the market is down about almost 170 points, Indian Hotels down just about 0.5%. So not too bad over there. Exide is also in focus. The stock is bucking the trend this morning as Morgan Stanley has raised the target price on Exide to 485 from 373 earlier. Zomato is the other stock I'm looking at. UBS has a buy. They've raised their target price on the stock to 250, but the stock is coming in for some correction now in tandem with the market. In the real estate space, Colte Patil is in focus. Its highest ever annual sales value at 2,822 crores, which is a growth of 26% year on year. Just keep that on your radar. Polycab is in focus. This entire space, Motilal Oswal has written a note where they've initiated a buy on Polycab with the target price of 7,500, big upside to the current market price, and they like this entire space. Now, there are a couple of heavyweights that will be in focus this week. Infosys comes out with earnings. Bajaj Auto comes out with numbers on 18th. So these stocks ahead of the numbers are in focus. And then you have something like Anand Rathi Wealth as well. They've exceeded FY24 guidance in terms of both revenues and profits. So Anand Rathi Wealth in focus. But remember, overall the market sentiment is weak. The Nifty is down almost 200 points. The Nifty Bank is really facing the heat this morning, down about 520 points. So it's not looking like a good start at all. Back to you guys.
All right, thanks a lot for that, Sonia. Well, a couple of stocks, though, are taking it hard, on the chin as we speak. Torrent Power is down. It's down big time, actually. It's down close to around 5% as we speak. So some selling pressure out there. NBCC is down close to around 6.5%. Rain Industry is down close to around 4.5%. And NCC as well, down close to around 4%. What's doing well? Well, a couple of these metal stocks are doing well. Vedanta actually has slipped into the red. So there is some selling on some of these stocks because they've actually already rallied big time. Even Hindustan Copper is down close to around 6.5%. But what's doing well? Well, Nalco is up close to around 2%. So that stock continues to hold in the green because it is an aluminium play. Hindalco as well is holding a little bit in the green, I think so, up close to around 1.5%. So both those two are pockets of strength, actually. ONGC is up close to around 1.5%. Maybe, in fact, some part of the capacity will go out of the way. So that explains why that stock as well. Well, what's under pressure? OMCs are under pressure. Crude oil prices are moving up. We have elections around the corner. So in all probability, they will not be able to push through this cost increase. And that's why you have BPCL, HVCL and IOC, all of them seeing some selling. Coal India is well down close to around 2.5%. So fair bit of red, Prashant, on the screen. We're very, very close to that, the 20 DMA, which comes in at around 22,270 for the time being, almost at around 22,300.
Absolutely. I mean, getting to the 1% cut mark for the Nifty, 22,322 or so is where we're at. Aster DM has got the largest volumes. That dividend announcement, of course, came, which was well expected. But I think the dividend number has come at the higher end of what the street was expecting. We'll have the management join us a little later. Look at the volumes, 3.6 million shares. It's by far the biggest volume-led gainer. Hindalco is up 2%, and I think Nigel mentioned some of the other metal stocks. TCS, it's a 1/3% higher start, so neither here nor there, but positive. Idea is up about 1.5%, 13.15. So, the anticipation, of course, is for the FPO. And that is starting higher this morning. ONGC is up about 1%. There is Senco, which is up 4%. Mangalam was telling us about Senco earlier. It's got large volumes on it for this point in the day. There's something called Pratham. Pratham is up some 18%. But I'm mentioning that because it's sort of coming up with large volumes. You don't usually see that name. At least I've not in the over the last many weeks now, but it's there. And Exide is popping up. Exide is up another 3% this morning. Stocks almost at about 410 rupees or so to begin the day. On the downside, IRDA, SJVN, NBCC. So these are all PSU names which are taking a bit of a knock. And these three have got the largest volumes as well. And there is Olectra, which is down about 6.5%. Of course, this is with regards to, investigative agencies over the weekend, I think, looking at one of the promoters for Olectra Green Tech. So there's a bit of a hit which is coming there. There's what else? GSFC down 6%. Rights, which is down 6%. A lot of PSUs. IIFL is down about 6% as well. IIFL was one of the 25% movers last week. So that's seeing a bit of a cut as well. Shipping Corporation is down 6%. So 2,000 stocks are down and 150 stocks are higher. So it's completely one-sided for now, but we'll see. 200 down now on the Nifty, approaching the 1% cut mark on the index. Andrew Holland is with us, Chief Executive Officer, Avendus Alternate Strategies. Andrew, good to have you with us here. Thank you very much. Even without all of this geopolitical bit of an upheaval, market here, as we left off last week, was looking a little weakish, right? Even the US market, and we were making this point on Friday morning, in the last 10 days, we've had some negative technical indicators, 2 bearish outside days in the US in the last 10 days. So even without Iran, Israel, etc., markets had kind of primed up a little bit. What's your sense near term, Andrew?
Not near term, Prashant. It's, if you think about it from that kind of, the problems that we saw in the middle of March, the market confidence came back. And we reached new highs. So, I think it's a little bit of taking money off the table. Obviously, the kind of geopolitical problems have increased in that time as well. And for the US, it's even though you've said what you've said, it's given the kind of data that's coming there for inflation or jobs has been a lot stronger than expected, and bond yields have risen. It's not really such a big fall for those markets, and you're seeing the same in Europe as well. It's not, if anything, I would just say it's just taking some money off the table, given the events. But given that it's just 1% or 1.5% falls, it's not significant. And I think on Friday, apart from the geopolitical tensions, you had some of the bank earnings in the US which disappointed. So obviously that had an impact on the sentiment as well. But I do see futures are kind of slightly higher in the morning. So maybe the geopolitical tensions are just hopefully will fade from here after the events over the weekend. So I'm still kind of not getting overly kind of negative on the market. I think these kind of corrections are okay. I don't think there's anything to worry about from what I can see at the moment.
All right, so there's nothing to worry about. These kind of corrections are perhaps par for the course, right, Andrew? So what do you do at a time like this? Do you just sit back, take a step back and just watch these events play out? Or do you use this dip? I mean, whatever it is, even if it's 2%, 3%, 5%, do you use it to get into the markets now? What's the best way to approach it?
Yeah, everyone's been kind of wondering, when should we get in? What's the timing? Should we wait? And then these opportunities come along, and I think it's a good time to be kind of dipping back into the markets. We had a pretty good showing on Friday. If you think about the expectation that market's going to fall, so maybe it's the reverse of that. Market falls this morning and then recovers during the day. And I would think if you like the themes that you want to play for the next 2 to 3 years, these are the opportunities you get, and just continue to deploy money at this point.
Hi, Andrew. Good morning and good to see you. And Nigel on this side. I recall when we spoke a couple of months ago, you said you like the metals pack. You're a little bit optimistic out there because you said China could probably come out with some stimulus. They've done something on ground, but maybe not enough, though the metal stocks have done very, very well in the last 3 months or so. What's the view on metals at current reckoning?
Yeah, well, obviously, metals have performed very well, and I think that will continue, particularly now that there's obviously sanctions going against Russia going forward, and we'll see what the LME says, the London Metal Exchange. But that's obviously good for the likes of copper and aluminium going forward. I still think maybe that the steel, whilst you'll see price increases, I still think there's overcapacity in China. So that could be the way to play it would be more kind of aluminium, copper versus steel at this point.
All right. So that's on the metal space and on steel. What's your view on how to approach IT now? We've just got TCS's earnings, but it's not as bad as what one would have perhaps feared earlier. The commentary was good, margins are good, deal wins are strong. But of course, there's so much changing in this sector, right, with generative AI, etc., taking center stage now. As an investor, how are you approaching it?
So I thought the results were good, actually. I think if you think about all the headwinds they have, I thought it was a very good set of results. And of course, they're going to be cautious because the US is still in that recovery phase, and it will take some time. But I think there's a bottoming out here for the IT sector, and I think we'll see what the results are like. But I think if TCS is a kind of the bellwether for what we can expect from other companies, then I think you'll see a lot more interest towards this sector. So dipping our toes, and of course, if interest rates do fall in the US at some point, I think that will be the extra tailwind for the sector. So you could wait for interest rates, or you could say that the bottom's already here. I think the bottom's already here for the likes of, looking at TCS's results, it looks as though the bottom's being made.
Just a quick look. I mean, the market, it's early, to actually look at market breadth in any significant way, but it's, of course, gives you a sense. It's all down. But volumes on the downside, if you just sort of rank stocks which are down by volumes, it's a pretty short list. So the, IRDA, Electra, NBCC, NLC India, and then you go down the list and volumes are lacking. Although the gainers list is much shorter, I would say there, the list of volume-led gainers is much longer. So that gives you a sense that there's still a fair bit of interest in specific names. Look at something like Ashiana Housing. There were reports that Ashiana's been able to sell out a project, I think in the NCR region, in 15 minutes flat. I mean, I think it was a luxury project. So Ashiana is coming up with large volumes, 500,000 shares there nearly coming through. You know, these chemical stocks had shown some signs of life last week. Jubilant Engraver is up about 3%, 3.5% right now. So we'll see. And of course, Idea is a fair bit of interest there as well, 2.25%. Just kind of investors trying to figure out whether post the FPO, the equity infusion from promoters, you know, there's money to be made here. Andrew, on Idea, what's your view? If you have any thoughts?
I can't really speak on individual stocks, Prashant, but obviously, you know, if I take that the funding goes through, this is good news for the whole sector. And I think with the government there, I think it will likely go through as well. And thereafter the elections, I think you'll start to see tariff increases as well. So I think you know, I think overall for the sector's probably poised for an upturn from where we are. So this, I think, will give confidence to investors in the players in the telecom market. So I think it's going to be good news. I don't see it as being bad news.
Okay, all right. Andrew, what about, you know, we have had Modi 1.0, Modi 2.0, and now we're preparing for Modi 3.0. What would be on your wish list? I mean, you know, what more would you expect from this government?
Well, the manifesto is not really kind of saying of any big bang reform, so it's more of the same from what I've read so far. And the themes, Nigel, are just not going to change, are they? I mean, you know, defense spending, renewable energy, railways, infrastructure. You know, those are the kind of big big spending the government's going to do, and that has multiplier effects across many different industries. And of course, those themes that we talked about before in terms of premiumization of the beverage market, leisure in terms of hotels and airlines, that's going to continue, and the electronic manufacturing sector as well. These have long runways of growth, to my mind, over the next 2 to 3 years. So I only see that the government will enhance this and you know, help in terms of whether it's spending on infrastructure or tourism or electronic manufacturing sector in terms of PLI. So I think, you know, all of those sectors I think will do very well.
One of the other sectors that has done very well this year is autos, right? So Bajaj Auto, for example, is up over 30%. Similar is the case with many of these other names, and electrification has been a great theme. You know, there's been a recovery once again in the rural markets as well. If this dip extends itself in the market, would you recommend buying into any of the auto stocks?
I think I'd probably look more at the auto components. I think I'm going to wait to see what Tesla comes out with, but I think that could have a good fill-up for the auto component sector going forward. I think that's the way I'd want to play autos at the moment. I think a lot of it's in the price for the main players. So I think the auto components is where I'd be looking to put more exposure at this point of time.
All right, Andrew, we'll leave it at that. Thanks a lot for joining in. I appreciate your thoughts here on CNBC-TV18, and have a great week. By the way, the bulls are not having a very good start to the week. The Nifty is now down 200 points. The sensex is down 670 points. We were expecting this to happen in the sense, you know, geopolitical tensions have sort of led to the market seeing a bit of a sell-off. But the important part is, does this extend itself through the course of the day, and will the dips get bought? Well, time will tell. But for now, we are moving on. Aster DM Healthcare is the stock that is really buzzing right now. Despite a fall in the market, the stock is up 10%. That's on the back of a special dividend announcement of 118 rupees per share. Also, there's no interim dividend will be declared for FY24. So to discuss more on this development, we have Nitish Shetty, who is the CEO of Aster DM Healthcare. Nitish, thanks a lot for joining in. Can you tell us a little bit about this special dividend? How much will be retained by the company in terms of, you know, the transaction proceeds? How much will be used as dividend distribution? If you can just take us through the way forward.
Yeah, good morning. You're aware of the special dividend announced by our board on 12th of April. 80% of the sale proceeds will be dividend out as a special dividend at 118 rupees per share, and around 1,500 crore will be retained within India. The future of the 1,500 crore, how we want to use it, will be decided in the near future by the board. Because as I speak now, we have clear-cut plans for our expansion in terms of deploying 1,700 beds in 3 years. This we are going to do with our own internal accrual because we have enough cash flow happening because most of our hospitals are matured now. For inorganic growth, we might consider this retained amount of 1,500 crores, or we might leverage on our share price, which is doing well, as you are aware now.
So, can you tell us what is the promoter stake right now, and any plans that the promoter has to divest further stake? Any plans to reduce the promoter pledges?
At this moment of time, our promoter, Dr. Bazaar, have made it very clear that they have no plans to dilute their stake. They believe in India's story. It has just started for SDM India now. We have plans to be a top 3 in the country. At this point of time, our promoters have no plans to dilute. They have been very clear about that.
Okay, all right. Hi, Mr. Shetty. Good morning and good to see you in. But Sonia asked you about the other part of the question, right? You're saying they don't want to sell out, but most of their holding of that 41.88% is pledged, 98% odd. Any plans to, release this pledge on the promoter holding?
Yeah, probably promoters will be in a better position to answer that question. But at this moment of time, they have plans to release the pledge at the earliest.
Okay. Do you want to give us a timeline by when they can do that?
Would not be in a position to say an exact timeline, but it will happen very soon.
Okay, all right. Now the focus is going to be on the domestic business. Earlier, bulk of the valuation was coming in from the overseas business or the Middle East business. So give us a few numbers. What is the current capacity? And say in the next 2 years, 3 years or so, where do you see the bed capacity headed? I'm looking at it in revenue terms. On a quarterly basis, you're doing close to 950 crores of revenues. Where do you see that number headed? Give us some outlook, because now you're going to be focusing on growing the India business.
Yeah, we are very, like I mentioned earlier, we have clear-cut plans of in the next 3 years of rolling of 1,700 beds. Presently, our capacity is at 4,800 now. We are planning to add 1,700 to take it to 6,600 beds in next 3 years' time. That is through organic route. Most of the bed addition will be happening through brownfield expansion. That means that we are expanding the existing hospital capacity because most of the hospitals are at 80% capacity now, occupancy. So that is the brownfield plan, and the greenfield is going to be 40% of our plan, which is primarily in Kerala cluster of ours, where we are adding 2 more new hospitals, one in North Kerala and one in South Kerala. In terms of other, we are also an integrated healthcare provider now. Apart from being a hospital player, we have labs and pharmacies. We have close to 250 pharmacies and 250 lab. We are also kind of planning for expansion of especially the lab vertical business in the near future.
Mr. Shetty, just to confirm, you currently have a plan to move from 4,800 beds to 6,500 beds and post 6,500, right?
6,600 beds.
Correct. And then besides that, you also have a greenfield plan. With that plan, what does it take the total capacity to, and by when?
No, 6,600 includes brownfield.
Includes everything. Got it.
Right.
And after that, like I mentioned, we also are open for inorganic expansion. We are exploring all the opportunities. We want to go beyond our geography. We are primarily present in 5 states now.
Got it.
And we would like to go beyond our geography also. We are exploring those opportunities also.
Right. So, I mean, you're strongest, Nitish, hi, good morning, Prashant here. You're strongest in Kerala, right? You said that you will obviously expand in Kerala as well. But you're looking at other metros now. Bangalore, for example.
Yeah, obviously, we have plans in metros because 70% of our business are coming from tier 2, tier 3 cities at this moment of time. We are majorly present in Kerala with close to 2,600 beds in Kerala alone. And we are adding more than 1,000 beds in Kerala in the next 3 years. So we have really a very dominant position in Kerala, but we are also expanding in Bangalore, and we are also looking at opportunities in Maharashtra, cities like Pune, and also up north in UP, in Lucknow.
Would this you sort of build this out on your own, Nitish, or is acquisition, etc., possible? Because there are, for example, I mean, Healthcare Global is a company where there is a large shareholding by private equity, which is it's on public record. They're looking to sell. I'm just not that one opportunity, but just that came to my mind. But this build out is going to be organic, on your own, or you're open to inorganic opportunities as well?
Yeah, we have clear laid out plan for organic growth, like I said, 1,700 beds. But at the same time, we are also exploring opportunities of inorganic opportunities, any merger and acquisition. So we are also open. Smartness is being agnostic in terms of the opportunities. We are not fixated with particular idea. We are open to all ideas will help us in growing quickly and faster. That's a need of the hour to be the top 3 in the country in the next 3 to 5 years.
What is that? How many beds will take you to that? I mean, you would have looked at the ranking in terms of the number of beds, right? Capacity.
Yeah, we are there now. We are there with the next 3 years with organic growth alone, 6,600 beds. We are already there, but we are contemplating taking beyond 10,000 beds.
By when?
By next 5 years.
Okay, 10,000 beds in the next 5 years. Got it. Just a couple of more questions. On Olympus Capital, they had divested about close to 10% stake in the business. How much stake do they have left at the moment, and any further stake sale plans by Olympus?
Yeah, they have around 10% now. They were at 19%. Now they have 10%. But I will not be able to comment on the Olympus plan. But as far as we are concerned, they have been a very supportive investor with us. They've been with us for more than a decade now. They have their plans, but about their plan going forward, I'll not be able to comment. But whatever they have sold in the market, their shares has been picked up by good foreign institutional investors and also domestic institutional investors. So that reflects on the fundamental strength of the Aster business.
They will continue to hold 10% at least for now.
Yeah,
that's the understanding, right?
I'll not be able to comment on their behalf, but looking at our fundamentals, I'm hopeful they might continue.
Okay. Any other private equity firms that would be interested in the company? Any talks that are ongoing currently?
There's a lot of interest. Like you've seen, our share price has appreciated substantially in the last 1 year. There is a lot of now India being a pure play India business now. There's a lot more clarity about our business compared to our peers in India. So there is a lot of interest. We are in a discussion, but it's very early to comment. Only 3 or 4 months down the line, clarity will emerge.
Okay. Finally, can you tell us about, you were talking about both the organic and the inorganic plans, but going forward in terms of the growth rate, what are we looking at in FY25 and FY26? How much would come via organic and how much via inorganic?
Yeah, in terms of revenue, you can say we have been growing next of 25% CAGR. That's the best in the market in the healthcare industry, especially in the hospital sector. We are hoping to grow at least 15% CAGR going forward next 3 to 5 years. And even EBITDA margin has been growing in next of 35%, around 35% in the last 5 years. And we envisage even that expanding and continue to grow at the same pace.
So this 15% CAGR, I mean, if you can just break it up for us, how much via organic, how much via inorganic are you looking at?
Yeah, this 15% I mentioned is organic only. But when we do the inorganic growth, we'll be in a better position to exactly project the growth rate. At this moment of time, I've not considered the inorganic growth, but only the organic.
Appreciate you joining in, Mr. Shetty, and wishing you all the best with those plans to go to 6,600 beds and then maybe 10,000 beds as well, as you told us. Well, we look forward to having a chat with you as you firm up those plans. Well, let's focus on a pharma company then, Lupin. That's been one of the big outperformers actually in the last 1 year or so, and plenty to talk about. To help us out with how's the business shaping up, we're joined by Mr. Ramesh Swaminathan, the Executive Director of Global CFO and Head Corporate Affairs. Hi, sir. Good morning, and always good to have you on the show. Well, you've got a couple of approvals. Orasia, you have got Ingrezza as well as Aptium. Those generics have got approvals. Could you tell us what is the potential sales that you could be getting from these recent approvals?
Thank you for having me on. It's always a pleasure. We don't talk about individual products, but all of those obviously add to the kitty. Mainstream obviously is going to be our respiratory portfolio that we have been trying to grow over time, and all of these products kind of chip in. So essentially, these are products which are important, but at the same time, the most important products are really out there in the market, which is respiratory products. And over time, we'll be looking at a host of others on the injectables front and the like.
Okay, could you give us some more color though, sir? What is the competition in some of these drugs? Is there limited competition? That's the sense that we get. So if you could throw some more color out there.
Yes, obviously, doxycycline, in fact, there is limited competition out there. It is going to be, none of these products are going to be huge grossers, so to speak. There would be intensity of competition coming up over time. But I think the more important point is the fact that the company is pivoting to more complex ones, which is essentially the respiratory portfolio, the injectables piece, and the like. And that is, I think, is what is going to drive the future as well as the performance in the near term.
Ramesh, hi, good morning. Prashant here. Not huge grossers, but possible to put some indicative numbers? I mean, in a ballpark?
You're not going to get a number from me.
Okay, got it. I had to try. Now, you were talking about the respiratory side of the business, right? Now, talk to us about how key drugs like Spiriva generic, that one is sort of shaping up. Again, I mean, some numbers would help, but give us qualitative comments as well. Go on.
Yes, of course, sir. Spiriva continues to do pretty well. So the new conversions are close to about 31-32%. The recent initiative by BI to actually restrict copay to $35, it doesn't really impact us. So we continue to do pretty well. And I think given the fact that there is no competition for it, at least from a generics perspective, it will continue to do very well for the next couple of years at least.
What about Suprep and, if I got this right, the HIV drug, which is Darunivar? I mean, how are those doing?
Those did very well for the time that they lasted out. As you could expect, the generic market is all about, a huge upside on launch and then thereafter a continuous decline. And that's really true with, in fact, the OSD portfolio. Suprep as well as, in fact, Darunavir had their, exclusivity for quite some time. There has been competition since then, and that's come down. And to that extent, that is on expected lines.
Okay. Ramesh, hi. Good morning. This is Sonia here. Always great talking to you, and thank you for taking the time out. Overall, for the US business, what is the kind of quarterly run rate we're looking at? I think last time you had mentioned $200 million per quarter is something you can sustain. Is that for FY25? Can you build on to that?
It should be around the same thing, about 200 or 210, so to speak, on a quarterly basis. It could go up a little, come down a little, but it will be in that vicinity. We have a number of products that we have lined up. There are, of course, the continuance of certain products in the ophthalmic range that we launched a few weeks ago. And going forward, there will be newer products that we would be launching, Mirabegron, potentially Slind, and so on as well. All of this will potentially add to the figures of 200 odd that you're speaking about on a quarterly basis.
So the US business is picking up. I mean, if you look at the last 5-6 quarters, right, the average sales run rate has picked up. Approvals are coming through as well. Can we also assume that you can build on to your margins? Because margins have hit 20%. But is there any scope to, are there any leverages for margins to go to 22-23% in the near future?
Well, for sure. So let's talk about the buoyancy on the top line. As you could see, there has been tremendous buoyancy over the last several quarters. And as we promised, in fact, the margins have also been creeping up. Over the last 5 quarters, we've been continuously increasing the margins. This is as a result of, in fact, the buoyancy that you see on the top line in America. And of course, the growth that you see in other parts of the globe also. India continues to do very well. And for sure, Europe, given the kind of respiratory products that we launched out there, and of course, Nemuscla, that's doing very well. The emerging markets, which is essentially Philippines, South Africa, have done very well. Mexico, which was actually undergoing some issues with the local FDA in the last quarter and a half, has also done well. There is some issue insofar as Brazil is concerned. But in a general sense, the companies, all the geographies are doing pretty well. We've also got out of a lot of our issues with the FDA and the like. That helps in terms of the number of products that you'd be bringing to the market. And of course, the focus on cost has paid off tremendously. We identified several initiatives and we worked on it across every line of the P&L, so to speak. Alternate vendor strategies in terms of routes to synthesis, looking at productivity of the workforce at the R&D front, at the plant front and the like. And of course, looking at SG&A expenses. All of this have translated into pretty good numbers for us, and the results are there to see.
All right, Mr. Swaminathan, I recall when we spoke the last time, you were telling us that the US business will continue to clock this $210 million odd on a quarterly basis, and gradually you will scale towards that $250 million, which will take you to the $1 billion mark on an annual basis. That's in the coming years. But I wanted a more qualitative, input from you on the price erosion. I think the last time you told us it was down to single digits. What is it at currently?
The price, erosion is a lot more benign these days. It's in the single-digit numbers insofar as the OSD portfolio is concerned. I think it's essentially because of two reasons. One is essentially a lot of companies have actually shared their portfolio, as we have also done, in recent times, and just focusing on products that are pretty profitable. And the second aspect is given the interest rate regime, interest rates in various parts of the globe, and for sure in America also, a lot of companies that had levered and have tried to sell their factories, close down companies and the like as well. And for that reason, the intensity of competition insofar as OSD is concerned has come down quite a bit, and that's contributed to the kind of benign regime that you see on the price front.
Just to kind of tie in that the price the price erosion bit. We got the US also gets into the election cycle. Do you see, Ramesh? I mean, there is a lot of noise around every quarter, especially now. But do you think that to be a bit of an issue going into the elections over the next couple of quarters, or not really?
I don't think anything is actually going to derail this, essentially because generic medicines are all about affordability, and as long as generic, it's important for these medicines to be out there. The IRA or recent regulations and all of that actually are focusing on, in fact, the ethical pharma bit, the branded pharma, those with IP and the like. It's not going to derail the process insofar as generic business is concerned.
Okay. I had a couple of more questions on the remediation measures of the companies Tarapur and Mandideep Unit 1. What's the status currently?
We are in a state of preparedness. It's a question of they coming over and inspecting once again. So it could happen anytime. And as with, in fact, the other factories, there is a lot of focus on QA and the compliance bit. The state of readiness there as well. You just saw the recent results with Bazaar. Very pleasing at that. We expect the same thing to happen to the other two units, which have been under scrutiny for some time.
And one final question on the diagnostics business. A lot of companies that we've spoken to in the past have said that the competitive pressures have eased, pricing pressures have eased as well. Is that something that you're noticing too? And what do you see as the outlook for the diagnostics business?
Yes, you're right about the fact that the intensity of competition, or for that matter, the price wars that we saw are actually coming to an end. We are pretty bullish about the diagnostic future. But having said that, it's never going to be the dominant theme. The most important thing from our perspective would continue to be the pharmaceutical business. But these are very useful adjacencies to have because it kind of adds to the overall patient centricity umbrella that we're trying to build out here.
Okay, all right, Mr. Swaminathan, always good hearing your thoughts. Thanks so much for joining in. Post your Q4 numbers, we'll get some more quantitative aspects as well that we can address. For the time being, thanks so much for joining in. Well, by the way, when we're having those chats with the management, just pull up the Nifty, the intraday chart. We went to the 20-day MA, which is at around 22,270. Our low today was around 22,263. And from there, we've seen a bit of a bounce. So very, very close to that 20-day MA is where we are trading at. Just around 25 points higher from that. In terms of a reference point, it becomes very, very crucial that we defend that mark. 22,200, well, that's the mark where you have the highest open interest on the put side. And that's where the 20-day MA as well comes in at 22,270. For the time being, we'll slip into a short break. When you come back, we'll get to our earnings season, quarter se quarter tak, and we'll be addressing the oil and gas space. Don't go anywhere.
Co-presented by Bank of Maharashtra.
Welcome back to Bazaar Morning Call. Well, for now, the market is not looking good at all. 1% lower on the index. But this is our segment Quarter Se Quarter Tak, where we get you expectations from each sector. Today, Sonal is with us to tell us how Q4 will be for the oil and gas sector. Over to you, Sonal.
Thank you so much for that. It's expected to be largely a good quarter for oil and gas space, but let's start with the basics. The Singapore gross refining margins, the GRM, surged to $7.3 per barrel in quarter 4 from $5.5 per barrel in the previous quarter. Brent crude prices remain relatively stable at $83 per barrel on a quarter-on-quarter basis. Now let's talk about Reliance. It is expected to report a consolidated EBITDA growth of around 4% on a quarter-on-quarter basis and 10% on a YY basis. The O2C segment is expected to see 11% increase in EBITDA, while retail and Jio will see low single digits on a quarter-on-quarter basis. Upstream companies like ONGC and Oil India are expected to see modest EBITDA growth of around 3 to 5% on a QOQ basis. This is primarily due to lower operational expenses, while volumes and realizations, they are anticipated to remain stable. Despite a mid-March cut in fuel prices, oil marketing companies are expected to experience a rise in marketing margins. The improvement in gross refining margins is expected to see a growth as well, and that is something that will be good for refining segment. Let's talk about the profit estimates. HPCL expected to see a big growth of around 200%, which is expected by Nuvama, and the others will see a mid-digit growth. Now, city gas distribution companies like IGL, MGL and Gujarat Gas are expected to witness volume growth of around 2 to 3% in the quarter. However, fluctuations in EBITDA per SCM are likely due to price adjustments. So IGL and MGL will see a decline due to price cuts. But Gujarat Gas is expected to do well in terms of EBITDA growth. Now about gas utilities, GAIL will see 6% increase in EBITDA due to decline in Henry Hub prices. Petronet LNG will see EBITDA to be up 4% on a quarter-on-quarter basis because of better Dahej utilization and tariffs. While for GSPL, it is expected to be flat in terms of EBITDA growth. So this is what is expected from the entire sector this quarter.
Thanks a lot for that. Well, Prabal Sen is also joining in, Senior Research Analyst, Oil and Gas at ICICI Securities. Prabal, you heard Sonal out. What would your big takeaway be from this quarter? What are the expectations this time around?
Well, I think broadly Sonal covered it. It looks like a pretty strong quarter for across the coverage universe. There's refining margins have gone up. Integrated petrochemical spreads have also shown a little bit of an improvement. Spot LNG prices have been a little bit under control. So to that extent, EBITDA margins, particularly for the CGD companies, have also improved. And for GAIL, the growth in transmission and trading margins, as well as some improvement that we expect to happen on the LPG and petrochemical margins front, means that even their numbers are going to be fairly solid. So from a overall perspective, I think the numbers actually obviously look fairly strong. I think Reliance also is going to likely to see a fairly strong recovery in its oil to chemical segment, which is likely to drive the QOQ improvement that we are looking at on both EBITDA and net profits front. So pretty strong quarter overall. Obviously, the macro has changed quite a bit, since then. So, depending on how the macro plays out, I think the reaction to these numbers will be determined. But from a quarter perspective, I think a fairly strong quarter in prospect across the board.
All right. Hi, Prabal. Good morning and good to see you. And, we have this news piece that we're addressing this morning and over the weekend as well with regard to the skirmish between Iran as well as Israel. Now, Iran has a fair bit of contribution both to the oil as well as the gas space. So could you quantify that number? What is their contribution?
Iran, I think, produces about 3 million barrels a day of oil, which is basically 3% of the overall oil supplies globally. And their gas production is actually the third largest in the world at about 700 odd MMSCMD. But interestingly, their exports actually are less than 3% of the global trade at, I think, somewhere around 50 MMSCMD, or about 13 to 14 million tons only out of the 400 million tons of LNG that's traded. So there's a lot of domestic consumption, but obviously in terms of the overall demand supply balance for both oil and gas, Iran is an extremely important component. So any disruption that happens to that supply, and I'm not saying it will, but any disruption, if it happens as a result of escalation of this conflict, will have a material impact on the global oil, and gas demand supply scenario as well as prices.
Okay. All right, Prabal, just to follow up on that question then, the OMCs have done very, very well. and there was that fear that maybe there'll be price cuts that'll come about getting into election. Some of those fears didn't really come through. Now the problem is that the Brent crude prices are spiking up, and since we're getting to election, if you have to get a price increase, it'll only happen post that. That's close to 3 months or so away.
Sure.
What's your view? I mean, could those stocks be under pressure? Will there be a risk to their earnings as well? How do you play them?
First of all, let me qualify saying that I'll only comment on HPCL. You'll have to forgive me that PPCL and IOCL are on our restricted list, so we can't really comment on our ratings or view on those two names. Having said that, HPCL, if you really look at it, obviously the marketing margins for the next couple of months will remain under pressure. There is no doubt that if marketing margins actually decline below the 3 rupees normalized margins that we're looking at for the full year, that has a fairly significant impact on the earnings and profitability. Having said that, the election results are likely to come in the first week of June. And, we would not like to speculate on when and to what extent the price increases to sort of align with the change in the crude and product prices will start to be allowed again. Our core contention is that, what we have seen in the past as well, that the government has been fairly proactive in terms of allowing the companies to recover their losses, or even if it is with a lag. So at this point of time, we would like to say that yes, there's probably 2 months of weakness that one is looking at, and therefore a slightly weaker first quarter. And to that extent, the FY25 earnings may see marginal downgrades. But from an overall year perspective, we would still like to believe that as and when price changes are actually started to be allowed as normal business, they can probably pass on the hit that will happen maybe with a $90 crude environment. So, that's what our core contention is as of now. Obviously, it's changing every week. So, it's fairly fluid in terms of how to look at it.
Okay. You want to just wrap up for us? What are the top picks in the sector? What is a void for you now? If you can just take us through your list.
Sure. We continue to be positive on GAIL, on MGL, on ONGC, Oil India, as well as HPCL in the space. We are a little bit cautious on Petronet LNG, specifically after the strength that the stock has seen right now, because we do believe that the capital allocation, specifically in the petrochemical project, will have, I think, a material impact in terms of return ratios and in terms of balance sheet quality, as well as, overall profitability over a longer term. So that is a stock that, we think, we are a bit negative on. Gujarat Gas, but also at this price, we are a bit cautious on. We do believe that multiples are at a sufficient premium over IGL and MGL. And there are enough concerns and volatility around Morbi volumes, as well as a lower than expected ramp up from the newer areas to, warrant skepticism, specifically at these price points. So that's broadly how, we're looking at it at this point.
All right, Prabal, thanks very much for that. Appreciate you joining in, and it's a pleasure having you with us here. Speak with you once you start to, once we start to get these results, etc. going. Just want to highlight one name. I'll put up PB Fintech, that is Policy Bazaar. On Friday, it sold off 5%. It's down another 5%, so 5.5%. So the high on Thursday was 1,400. Not Thursday. Thursday was a holiday, but Wednesday was 1,400 rupees was the high. And from 1,400 is down to under 1,200 in 2 days flat. Now, that the last news, of course, was the fact that ICICI Lombard, so the largest general insurance player, comes on the PB Fintech platform. And there was a bit of a run-up in response to that. But, I mean, this, even in the light of that run-up, getting corrected is a bit excessive that we have seen. Not sure if there's any specific news flow, but that is a large cut. And by the way, it's got third largest volume-led loser right now on the NSE. It's still 10:1 in terms of declines outnumbering advances. So pretty deep in the red market breadth overall. Mitesh Thakkar is with us. Mitesh, hi. Good morning again. So the Nifty's gone to almost the 20-day and then bounced a little bit. Do you think eventually we will see a break?
See, I think, Prashant, there's this 20-day average. There is this historical pivot of 22,250. We took a lot of time clearing that, and therefore it becomes a support pivot. But the gap down in the position of the indicator is not very good. So while you may get some kind of a bounce back today, maybe till tomorrow afternoon, I think at higher levels you will see supply re-emerge. So the idea is to now wait for this bounce back to play into. Closer to about 22,400, 450 zones is where I would want to go aggressively short or buy into put options for the April end expiry. And the idea is to now, in the short term at least, be a seller on rallies. So slightly negative view, but not tactically. I think this is not the best time to initiate short. So wait for that pullback to happen, or you go short once we see the 20-day being taken out.
All right, Mitesh, any individual stocks you're looking at?
Yeah, in fact, a couple of them. I think Gas Authority on the long side can be bought with a stop below 198 for targets of 210. And on the short side, I have a sell on Canara Bank, which I would recommend selling with a stop above 605 for targets of 580 to about 578.
Okay, all right. Thanks a lot for that. Let's slip into a quick break. On the other side of the break, Manisha Gupta joins in for a quick roundup of the commodity market. Stay with us. Well, let's take a quick look at what's happening in the commodity markets. Manisha is joining in. Manisha, what's the one commodity you're looking at today?
Well, I'm looking at the metal as a sector, Sonia, because we've seen a huge jump come in for the Asian markets onto this one. Given the fact that we are looking at geopolitical tensions, so most of the tangible commodities have been doing well. But the metal surge of between 1 to 5% in Asia also comes in on the back of the weekend news, where we have the US and the UK telling Russia that they will not be taking any Russian metal delivery on their exchanges. So these are a couple of top exchanges, CME and LME both, which where you look at for metal prices, will not take Russian metal on the exchanges anymore starting 1st of April. But not just that, the imports also have been banned of aluminum, copper and nickel from both of these countries. Now, if you look at the number really, much of the metal that is lying on LME right now is from Russia itself. So whether it is about aluminum, 91% of aluminum, which is on LME right now, belongs to Russia. We are looking at stronger numbers at 62% in sense of copper, and 36% of nickel, which is on LME warehouses, also comes in from Russia. So these are huge numbers, and especially in case of aluminum, if there is no more metal coming in from Russia, you are looking at those concerns coming in for this metal. I want to talk a bit more about aluminum because the prices did surge 5% in Asia today. So this has been an outperformer within the sector. We are looking at 13% of gains in sense of prices in 2024 till by far as well. There also are tight supplies in the Asian markets, which have been supportive for the aluminum prices. If you look at the premium for Japan, that has been on the higher side as well. So from the month of April to June, the premium that Japanese buyers will pay for aluminum has been hiked up by nearly 60% to the tune of $145 to $148. Last quarter, it was at $90. So you are looking at that 60 to 65% of a jump for aluminum buying. So whether it's about disruptions that we are seeing or supply, pardon me, we are looking at support coming in for aluminum because of that. Copper should come in on your screens because that's one is trading at 14-month highs. You have zinc now trading at a 12-month highs. Iron ore and nickel prices trading at a 2-week highs. We have seen 1 to 3% of jump come in across these metals as well. There is important data coming in for this week as well. You have the first quarter GDP numbers from China that comes in tomorrow. And then Japan trade data and inflation numbers also coming in on Wednesday and Friday. So further cues would come in from that. But it definitely is a buy continuing in case of metal prices until then.
Manisha, thanks very much for that. So some support there as far as commodities are concerned. Manisha, thank you. Well, Senco Gold, let's just revisit that name. Mangalam highlighted that pre-open, stocks up 7%. Mangalam, back to you.
Well, the stock is doing extremely well in today's trading session, and that makes it the third jewelry company to report good numbers. And there are three reasons why Senco Gold is doing the way it is as against the other companies. The first one is that the revenue growth, 39% revenue growth for the fourth quarter is extremely strong. It's stronger than the 38% that Kalyan Jewellers reported and stronger than the 20% that Titan reported as well. The second parameter was same-store sales growth came in at around 23%. That's a positive. And the third one is that this is the only company so far which has reported better studded ratio than the others. So, 11.4% studded ratio implies better margins for the company as well in the fourth quarter. They've added 4 stores in the fourth quarter, 23 in this year. It's a recent listing. So 23 stores in a financial year is the highest that the company has added in a year. And for FY24 itself, a 13% volume growth in gold prices with in gold sales and 19% growth in diamond volumes. It's something that the street is celebrating. And add to that, they are optimistic about FY25 as well, with the first quarter itself having a lot of festivals, the New Year's that took place over the weekend, Akshaya Tritiya and the wedding season, all of them poised for good growth. And with gold prices rising, they say that it's the unorganized players which tend to, lose out, whereas the organized players try to consolidate their industry leadership, and as a result of which the stock up 14% as we speak.
All right, thanks a lot for that. Well, let's move across to Hormuz. He's tracking the mutual fund holdings changes that we've seen. Some interesting changes there. Hormuz, over to you.
Very interesting changes actually, Sonia, as you were mentioning. And some will start off with the large cap names, and this is across fund houses. And some of the main additions that they have made in the month of March include Reliance Industries, TCS, ITC, and of course that shift that we were talking about towards the large private sector banks, because Kotak Mahindra Bank and HDFC Bank also feature in those list of additions. Among the reductions that the mutual funds have made, and there's a shift there from PSU to private banks because SBI features in that list of reductions. Infosys, ICICI Bank and Shriram Finance also feature in the list of reductions there. Among the mid-cap stocks that were added during the month of March, those include Max Healthcare, Aurobindo Pharma, Indus Towers as well. The stock did very well in the month of March, so that is an addition. Samvardhana Motherson and a beaten down name like Jubilant Foodworks also features in the names of additions. Among the top mid-cap reductions, Sundaram Finance, there is Ashok Leyland, there is Ramco Cements, there is Lupin, and APL Apollo Tubes as well. Now, all of this is also from a note from Nuvama citing ASMF as well. The top small cap additions that they have made, those include the likes of NLC India, Aavas Financiers, Aster DM. Of course, the stock is up and about in today's session. Aditya Birla Sun Life AMC, another underperforming stock but features in the list of additions, and GR Infra. And among the top small cap reductions include Amara Raja. We've been highlighting about how mutual funds have increased their stake in battery makers, both Amara Raja and Exide over the last few quarters, but those features in the list of reductions. Bata, IDFC and Carborundum Universal features in the list of small cap reductions. Amongst small cap exits, funds that have completely exited names like Force Motors, Associated Alcohols, JBM Auto and GPT Infra. And some other interesting observations that this note highlights is Tata Chemicals, which we saw the stock surge in the month over the last few months because of the Tata Sons listing and then the correction that it saw. Here, Quant MF and ICICI Prudential have bought fresh stake in the company. Ireda, the stock is down almost 8% in today's session. Then three mutual funds, Nippon, Kotak and ICICI Prudential have exited the stock. Tata Technologies as well, a recent listing, a stellar listing, but Nippon India Mutual Fund and ICICI Prudential have exited the stock. Lancer Container Lines, that's an interesting name that comes up, where Quant Mutual Fund has bought fresh stake at around 2.5%, and that is evident from its March shareholding as well. And Axis MF has completely exited Hindustan Unilever and has increased its stake in Colgate Palmolive. And lastly, ICICI Securities, now that stock is in focus because of its delisting, but here Kotak MF and ICICI Prudential have bought stake in ICICI Securities. So interesting names there, but some important names like Ireda are in focus at today's session as well. Back to you.
All right. Thanks very much, Hormuz, for that. So that's a very interesting compilation of what mutual funds are buying and selling, the latest that they've done across a range of mid, small and large cap stocks. We'll take a break here. We put the focus on the skies, aviation, right? I mean, Mayur Malik of Asian Market Securities and Jaganaraya Padmanabhan of CRISIL will be joining in. We got lots happening in that space. The market leader, which is Indigo, of course, the stock's trading at an all-time high, has done very well over the last couple of years. That discussion coming up.
What does...
Well, let's focus on the aviation space now. The domestic passenger traffic in FY24 saw a 13% year-on-year growth. ICRA put out a note where they said that there's a stable outlook in the Indian aviation industry and they expect relatively stable cost environment in FY25 as well. To discuss how FY25 is looking for the sector, we are joined by Mayur Milak, who's the Senior Research Analyst at Asian Market Securities, and Jaganarayan Padmanabhan, who is the Senior Director and Global Head Transport, Mobility and Logistics Consulting at CRISIL Market Intelligence. So, gentlemen, morning to both of you. Jaganarayan, I want to start with you because, it has been a very healthy growth that this sector has seen, but it's also come with its own fair share of problems in the recent past. What is the outlook in FY25 for the aviation sector, given how travel and tourism is booming now?
Yeah, so I'll split this into two parts. One is in the summer part of it, which is the summer schedule, and then the overall growth for the FY25 part of it. So on the domestic passenger traffic part of it, we expect a growth of about 8 to 12%. year on year in the summer schedule. And for the fiscal 2025, the domestic passenger traffic is expected to rise by about 12 to 15%. This is because of the supply issues getting eased out, and also we see a lot of additional capacity which is coming into the system later part of the year. And the travel sentiments across leisure, MICE, and the business is also pretty good. On the international part of it, on the summer schedule, we expect about a growth of about 10 to 12%. And also, this is going to be aided by a 15% growth across all major airlines. So that's the overall focus that we are having for summer schedule and for the overall FY 2025.
Okay, got it. So that's the overall setup of how, growth would be, right? You're saying there's an 8 to 12% growth in the domestic passenger traffic segment that you're looking at in the summer schedule. And you gave us the full year numbers as well. But recently we've seen massive flight cancellations from Vistara and all the troubles because of what's happening there. What do you think the ramifications of this would be on the industry, both in terms of growth and the other incumbent players, and how they can sort of, grow here on?
No, sure. I think and also there's a lot more growing in terms of the overall flight duty time limitations. These aspects have also started to kick in. Is on the shorter term perspective, yes, there is going to be some level of an impact which would be there. But having said that, in the medium term, and as far as the guidance which is given for the overall FY 2025, as we can see, we don't see much of a disruption happening. Also, new entrants like Akasa have ramped up their operations. They've grown significantly well. And also in the flights that they have ordered, which has happened, like Indigo planning to double up its own fleet capacity, Air India on the same heels, having about close to 470 odd aircrafts being ordered. All of these supply-related aspects will also start to come in. We're also seeing a lot more addition in the wide body happening, and hence some level of constraint which is happening because of the flight cancellations will be compensated by higher capacity, which also we expect to grow at about 8 to 10% of larger aircraft coming in.
Mr. Padmanabhan, so then we should not be talking about caps on airfares, etc., right? No need for that. Once in a while, people start talking about it.
No, I'm no one to comment on whether we put across or not, but the demand and supply is quite healthy. And with duopoly being there in the skies just now, and also Akasa coming in through, I think the market forces will even it out. I'm not equipped to comment on the cap on airfares.
Mayur, same question to you. I mean, you heard Mr. Padmanabhan on some of these issues. He says demand is healthy, the supply is also matching it, especially with Akasa coming in and adding capacity. What's your own sense?
We are in a time where demand looks pretty steady. So I think, yes, I'll quite vouch the fact that if you're looking at a 10 to 12% kind of growth, pretty much looks doable at the pace that we are at this point. Supplies, I really never thought was an issue in the first place. In fact, for all the industry was always worried that will supply be ahead of demand. So I think at this point in time, this looks pretty sorted. I think more of a worry is, the international things that are really happening at this point and its impact on crude. So that is where, as an analyst, I'm more worried. Really not worried much on the demand side as such.
Mayur, you've been tracking Indigo for so long, right? I mean, the stock is sitting at a fresh high. Of course, it continues to have market leadership. But now that problems continue with players like Vistara, which was the only strong player, so to speak, in the market at the moment, it seems to be once again in Indigo's favor. Your thoughts on how this is going to play out, both in terms of growth for Indigo as well as yields?
So I think, I've maintained one stand, especially post-COVID, that there has been a lot of discipline in the Indian skies, the kind of pain the aviation industry went through. So despite, everything quite sorting out, we've never seen this airfare war back again. So I think despite crude coming in the correction zone, these guys have made up healthy money. So I want to believe that this continues. Indigo, of course, always stands to gain at anybody else's peril, So, but I really don't say that the issue at Vistara would be a long-stand one. I think a temporary one should give them some advantage. But overall, I still think that the Indian skies are pretty good for all the players who are, at this point in time, making some market share out of it.
Okay, so you're saying Indigo stands to gain, but the issues at Vistara seem to be temporary in nature. Got that. Jagannarayan, I wanted your thoughts on the crude prices because there was a sequential decline. Of course, that had helped the earnings last quarter. But now, once again, with geopolitical tensions rising, crude is back above $90 a barrel. What do you think the ramifications of this would be on the earnings for many of the aviation companies?
Yeah, you're right. I think crude was one of the significant cost component as far as the overall workings of an airline is concerned, and it constitutes close to about upwards of 40%, between 40 and 45%. So any pressure there will have a ramification on the overall workings and the profitability of an airline. But as my colleague just pointed out, the margins for the single largest player is quite healthy at about 24%. Yes, this also, and I think on the pricing part as well, a lot of discipline has been shown by the players. Yes, so if the crude continues to increase, I would stand to believe that they would want to pass this on to the consumer by an increase in the airfare, and they have the ability to pass that on as well. So overall, the impact, if it goes above $100, then it's a different story. But I think as things stand, the VA passing on this benefit, passing on this to the consumer would be there. And second is the margins are quite healthy to absorb it as well.
Okay, the margins are healthy at this point in time to absorb the higher crude prices. Got it. Gentlemen, thanks for joining in and giving us a quick snapshot of what to expect in the aviation industry. Appreciate your time here. By the way, we've run out of time on Bazaar. We're leaving it with the Nifty down about 150 points. The good part is we haven't seen any worsening of the market since the initial gap down opening. But the bad part is we haven't seen any recovery either. So it promises to be a slightly volatile and slightly unpredictable day for the market, given that we have geopolitical tensions. But let's do one thing. Let us wrap the show. We leave you with a CNN News 18 exclusive. Finance Minister Nirmala Sitharaman, in an exclusive conversation with CNN News 18's Zaka Jacob, said that the government is now focusing towards laying the foundation for taking India through the next 25 years to reach the destination, which is developed India. Listen in to a short excerpt from that conversation. Chartbusters will come up next.
In the 10 years that we have provided the basis for what we can take India to the next level, meaning we should lay the foundation for taking India through the next 25 years to reach the destination, which is developed India. So that is the first thing which was in his mind, and he ensured that there are indicators for the steps that we are planning to take Indian economy further. But equally, his emphasis was that we should not relentlessly pursue the welfare schemes. In a way, I don't want to use welfare as a word here. It was more to empower the poorest of the poor and make sure that we are able to support our farmers and provide enough opportunities to skill themselves for the youth, and above all, and very centrally to this whole thing, to keep women not just at the center of policy making, but to keep them up front there, so that it will be women-led all through. So these four groups on whom he has been talking a lot in the recent past is to ensure that through them, women belonging to various castes or youth belonging to rural, urban areas, irrespective of the caste differences or the income differences, farmers across the country, particularly the small farmers, particularly the kind of farmers who grow Shri Anna, that is the coarse grains, millets and the other superfoods. So emphasis was on these. So everything that we had to do was very clearly put through this filter and tested if it will stand the test of time. Above all, I should recognize more than 15 lakh inputs which had come from the people of India saying we'd like you to put this aspect in the budget, and I mean in the Sankalp Patra and so on. So we've given a lot of emphasis for those inputs which have come also, and the Prime Minister was keen that we go through each one of them, and there was a large team sitting and sifting through the inputs which had come.
So, ma'am, there are two ends of the pyramid. One at the top end of the pyramid, The manifesto talks about, Viksit Bharat, about putting a manned mission into space, having India's own space station, EV manufacturing hub. And at the bottom end of the pyramid, as you said, there is a welfare stamp, no doubt, whether it is extending the free food, free ration scheme to 80 crore people, whether it is, 3 crore new homes for the poor, so on and so forth. Isn't there a contradiction between the two? On the one hand, you have a pathway to Viksit Bharat. On the other hand, you also realize that everything is not hunky-dory.
Well, I don't want to put it as it's not hunky-dory. It is a matter of reality that we have a section of our population which still needs to be empowered. And that is why you have the PM Garib Kalyan Anna Yojana, which is extended for another 5 years. You also have a section of our population which is the farming community, particularly the small farmers, who against all odds, some man-made odds, some nature-made odds like the climate, extreme weather conditions, are giving us food on our table. So are we not going to support them? And therefore we made sure that in order to empower the farmers to be able to better perform in their farms, we need to get technology there, get the drones going there, ensure that fertilizer, the dependence on imported fertilizer be brought down, and subsidize fertilizer so that the farmer is not paying through his nose for an essential input. So thought has been applied to empowering sections of Indian society which with dignity intact can grow into the system and contribute to the system. Whereas if you talk from the point of view of only Garibi Hatao, you don't seem to understand and appreciate the nuance that the policy should take in order to empower them. That is why we have gone to talking about it, not from the point of view of welfare, but more from the point of view of empowering them.